Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello, and welcome to a brand new, fresh edition of Bazaar Morning Call. We're coming to you, of course, from the CNBC-TV18 Motilal Oswal studios, and I have both the boys with me this morning. We're missing Prashant in action. But, guys, morning. I think not too much cues overnight because it was a holiday in the US. But I guess the bulls here are going to hope that they can get some reprieve. And yesterday's slight pause in the selling, maybe at least that can sustain.
Well, that's right. At least you live to fight another day, right? So yesterday, after a while, you had the losing streak that was broken. 8 straight sessions we ended in the red. So good to see some green. We started the the week at least on a positive note, and you hope that there is some kind of stability. Forget about running away. Some kind of stability.
Maybe Manglam is going to be that good luck charm.
Yes,
I hope so. If only it was that easy. But to be very honest, it's a good thing that we recovered from the lows. What's not good is that we recovered from lows in the absence of the FII volume. So let's see whether that continues or not. But just generally, we're in this low news sort of phase for the market, right? Where, there is not much in terms of a big trigger coming in. All the big news is out of the way. I was just looking at the big cues for the week, and the only thing that the street seems very excited about are the minutes of the FOMC meet that already took place. So that's telling you about, how many things people are looking forward to. But be that as it may, let's, talk about what are the important cues that we're looking at. First up, Surabhi, what do you have on your list?
So, like you said, not too much action, overnight on Wall Street. We're looking at, some mild gains in futures coming through right now. The only sort of, noteworthy commentary last night came in from one of the Federal Reserve governors. So this is coming in from Governor Michelle Bowman. And she went on to say that we need to see some more stability, some more improvement on the inflation front before charging ahead on the rate cut path. So the markets were sort of, not trading. But perhaps that's a comment that they'll take on board. The good news is that the dollar index has cooled off in the last couple of sessions, and we're looking at levels below 107 persisting even this morning, though it's moved up. Yesterday's low on the dollar index was 106.74. From there, slightly higher this morning, but nonetheless, it's a level below 107, and that's good for equities. But the bigger talking points are really coming in from China. And in the last 24 hours, the biggest meeting that's made the headlines is the Chinese president meeting with members of industry, meeting with the private sector, trying to fire up the Chinese animal spirits. Why are we tracking that here? Because we know what's happening in terms of the outperformance and underperformance. The India-China question is very much alive from a market standpoint. So what happened in this meeting that took place yesterday? It was a closed-door symposium, and Mr. Zhe made some very, very interesting points. He is now calling for a clean, quote-unquote, clean relationship between the private sector businesses and between the government. And remember, this is a meeting that's coming in after the big crackdown in 2020 that we had during COVID, when there was a crackdown on large Chinese tech firms and all that chatter, whether they were becoming too big for the state itself. So after that, by the way, Mr. Jack Ma was present at this meeting. There were executives from, big Chinese enterprises like Meituan, Xiaomi. Many of these big corporations were represented in that meeting, so to speak. Now, what did the meeting really say? And I want to put up this quote because it's an important one. He seems to be addressing what's the heart of the issues that cropped up in 2020. And he goes on to say that we must focus on solving the problem of arrears of accounts owed to private enterprises. We must strengthen law enforcement supervision, focus on rectifying random charges, fines, inspections, and seizures, and effectively protect the legitimate rights and interests of private enterprises and private entrepreneurs in accordance with the law. So perhaps do away with random fines, seizures, and inspections. So this is exactly what a lot of Chinese enterprises were complaining of over the last couple of years. And he also goes on to say that some of the economic issues are temporary in nature, and that, the private sector can really go ahead with the investment. What does this mean? I mean, some of this has already been building into the markets. The excitement that started with DeepSeek, is it spreading? Is it getting a little wider? We've been asking our experts this as well, and that's the picture. The rally has been largely restricted to the Hong Kong listed market right now. If it starts spreading to the mainland market, Shanghai Composite is up about 3.2% in the last 1 month. If more money starts getting sucked into Asia, which is what some of our guests were saying yesterday as well, obviously it would be a lot of competition for India. We know what we've done in the last 1 month. I mean, the Nifty's been under pressure, down about 2-3%. Now to talk about the trade here back home. Yesterday was a day of respite because we did manage to at least preserve and protect the 22,800 mark. Is this the bottom formation process? Have we seen the worst of the shakeouts and the shakedowns or not? Is the mid-cap pain over? Well, the answers will only reveal themselves as the day progresses, the next couple of days progress. But of course, we've still got pressure from the foreign institutional flows, and we'll talk more about that as we go forward. But Nigel, I guess, like you said, I completely concur. If the market can at least hold its own, stop falling, just consolidate 1 or 2 sessions, I think that also is going to be a positive sign.
Well, more time at the pitch, helps you get into better form. So I think that's something that I'll be looking at. And the question now is, we're talking about double, triple, and has the market made a quadruple bottom? That's going to be important because the recent low of around this 22,700, 22,750, that's going to be the important mark. So that's the question, quadruple support or not? Well, that's something that we'll be looking at. Yesterday was a good session, no doubt, and we have got a good recovery from the day's low, but you need to note that the FI participation, the gross volumes are 30% lower than on the average that we saw last week itself. So that's clearly telling you that we didn't have full participation, and that could be one of the reasons that we outperformed. So today actually will be the real test. Moving to, the F&O data points that we got, yes, the markets moved up, and there was open interest shared both on the Nifty as well as in the Nifty Bank. That's telling you there's a bit of a short covering bounce that did play out in yesterday's trading session. And you put in the FI data points, it perfectly fits in. Because on the index futures, there was mild short covering that we saw out there. They continue to remain net short though out there. And on stock futures as well, you did see a short covering bounce that did play out. So there was long addition that we saw, and there were some shorts that did cover out. Though you need to note that on stock futures, the FIs actually are net long. And that's why both the clients as well as the FIs on select stocks, that's on stock futures, they are net long as well. There could be an arbitrage that plays out there, but that's the data point that we have. I'm looking at the options data then, the 22,800 call, 22,800 put. Both of them were fairly active in trade yesterday. 22,800 call, not so much, but otherwise, if you put this premium together, you get a close to around 350 rupees or thereabouts. So in case there's a strategy that's playing out, then you're adding 350 rupees to around this 22,800, and then you're deducting 22,800, if that is the case, which is known as a short straddle. So if that's the case, then you're playing for this broad band of close to around 700 points. So just fitting in, the options data, as well as the recent levels that we looked at, the crucial support comes in at around 22,700. With as per the options data, well, then you can look at around 22,500 as well. But that's the first line in the sand that you're looking at, 22,700. You don't want that mark to get broken. On the upside, last week we made an attempt to get to around 22,150. And from there, we did take a U-turn. 20,150 is an important mark on the upside. The bulls would get confidence only once we get past this mark. What was encouraging yesterday was the Nifty Bank. It ended very, very close to the 20 DMA. It ended actually pat in line with the 20 DMA. And that's the one that we'll actually have to build on from here if, in fact, we need to see higher levels. So the 50,000, there's a lot of resistance at that mark. You'll want to see the Nifty Bank scale up from those levels. That's going to be important. And finally, your portfolio will be feeling good yesterday after a while because the number of stocks that were advancing, well, that moved up a little bit. And all through the trading session, you did see fair bit of, buying on select stocks. So that's why you had close to around 900 stocks that were advancing. You want that number to be in that vicinity of around 900 to around 1,000 because there were days in the past week when, in fact, we did see just 200-300 stocks that were advancing. So for the time being, some kind of consolidation will be okay. The bulls will not want the 22,700 mark to break on the downside. Mangalam, what about you?
I take that point. The bulls will not want that mark to be broken down. And we had limited cues coming in from Wall Street. We do know that the Wall Street trading was on close on account of President's Day. But the US futures are higher for what it's worth, 0.2% higher on all the frontline indices. And the big event that we will be watching out for from Wall Street this time around would be the Fed minutes, where, there was some sort of aversion towards further rate cuts coming in. So what is the key cue coming in from there is something we'll be tracking very, very closely. Importantly, if you look at the macros as well, not much change. The US 10-year yield close around 4.5, the dollar index hovering just below that 107 mark. The good part for us here is that the continued slippage of Brent, is positive for India. It's now closer to that $75 per barrel sort of mark itself. Here, the Nifty snapped its 8-day losing streak, gained about 234 points from yesterday. You spoke about a quadruple bottom. Look at those, levels. Jan 27, 22,787, Feb 12, 22,789, 798 rather. And yesterday, the low was the lowest, 22,725. But even the bounce from the lows was the highest itself. The good parts, Nifty Bank led the recovery. Second part, you had both HDFC Bank and Reliance, index heavyweight heavyweights coming back into form. So we'll keep an eye out on whether this sustains or not. And then the cash market flows. Yes, the FII sold, but gross volumes, like you pointed out, were on the lower side itself. Whether this recovery continues or not is something we'll be watching out for. The most important thing for this recovery to continue will be, the 20-day moving average. That is something that we'll need to see crossing on a sustainable basis, perhaps closing above that as well. The Nifty, fair distance away from that, but the Nifty Bank is just about 100, 200 points away from the 20-day moving average. If the Nifty Bank, which continued to lead the recovery yesterday, can support the frontline indices and close above the 20-day moving average, maybe bulls will have some hope for the Nifty to move further as well.
Absolutely, and bulls are right now living on hope, living on a prayer, call it what you want. But that's exactly what the last couple of days have been about. And yesterday, at least, we had some respite from the selling pressure. So let's kick it off with the equity call of the morning. And this one is coming from one, long-time India bull. Rhythm Desai of Morgan Stanley says, third quarter FY25 earnings growth was up sequentially, beating low analyst expectations. He says the market looks good for a near-term bottom given improving growth. He says if global cues do not surprise negatively, India should resume its outperformance versus EM soon. Their best bottom-up ideas following the earnings season are overweights on L&T, Bajaj Finance, ICICI Bank, M&M, Titan, Trent, Maruti. And they're underweight on Aisha, RBL Bank, Wipro and Concord. That's interesting, overweight, including a Trent, which has been beaten down badly in the sell-off in the last 1 month. Okay. Let's quickly move on and take the conversation forward with our first guest on the show. Anurag Singh, managing partner at Ansett Capital, is with us. Anurag, great to have you on the show with us. Thanks so much. First we were just looking at ourselves and looking at Wall Street and the outperformance over there. And now we have to start looking over our shoulders and look at China because that market started doing well as well. What have you made of the sell-off? I mean, it's the same question we've been asking you, right? But the sell-off has continued here in India. Is it time that foreign investors start buying in? Have we reached those levels in terms of valuations?
Yeah. So, good morning. Yeah, I understand. Look, I think, and there is no clear answer to that, right? So I can't pretend that I know the answer, right? So multiple reasons we have discussed, right? There's no point repeating that, right? So, as long as the 10-year yield doesn't settle, as long as the dollar doesn't settle, as long as the rupee doesn't depreciate much, significantly, I think so we'll continue to face these headwinds. But outside of that, I think, look, India was a beneficiary of this for the last 3 years where, go 3-4 years back, China used to be 33% in MSCI, and again, add Taiwan another 12%. This block used to be 45%. And India was somewhere between like 15, 16, 13 to 15. And India got up till 20% and China came down to like 20, 25%, 23, 24. And I think some of that is reversing, right? Because China was very cheap and on the margins, especially with the DeepSeek. I think this has really rekindled hope. And by the way, their Xi Jinping is meeting the corporate investors and business people as well. So I think this is kind of bringing back the hopes that, China may not be as against the capitalism as earlier thought out to be, right? So I think all this combined, plus, I think, Indian market was good, fairly valued, good story, but there's no surprise there. There's no big trigger. It's good, but not for the time being, right? So if you're invested, that's fine. But otherwise, there might be short-term money might be chasing, China for the time being, right? And US, by the way, right? So there's no, I mean, it's a popular trade. It's, I don't know whether it'll be right or wrong, but currently the trade is go long US, long China.
All right. Hi, Anurag. Good morning. And interesting, as always, you've been maintaining that stance, right? That India seemed to have run ahead of themselves a little bit. And I think that point on the SIPs makes me a little bit nervous, but I'm keeping it going out here in India. Hopefully, it makes my kids good money. But, a couple of points with regard to these FI flows. The rupee, at least in the near term, is showing some signs of stability, which, we had spoken about last time around. Do you think, with the kind of stability that we're seeing of late, the FI selling has been very, very relentless here in India. Do you think there is, there is a debate that, in fact, maybe, or there's a point that maybe they slow down a little bit, at least in the near term, and maybe the second half of the year could be better with regard to FI flows? And also in the the Nifty 500 companies, you had made this point that there's plenty of froth in the broader markets. But if the earnings season has just concluded, actually wasn't so bad because the earnings growth was roughly around 8.5%. Not great, but at least better than what we saw in the previous 2 quarters. So a quick word on the flows as well as on the broader markets here in India.
Correct. Nigel, a lot to unpack there. So, by the way, keep the SIPs going. My opposition to the whole concept was that 80% of Indian SIPs were going to mid and small. That's a wrong concept. As a broad idea, 70% should go to large cap, and then remaining 30 you can do whatever, right? Debt funds, mid, small, whatever. If people think mid and small going to outperform large cap in 20 years, I don't believe, but that's my thought. And that's historical thought till 2019. That's what the data suggests. I'm not selectively picking data from selective years. That is from 1994, since inception of Nifty. So that has been my thought, but let's see how it plays out, right? But if it is in large cap SIPs, 12% is not going anywhere, keep it going, right? That's one story. Nifty 500, Nigel, again, till 2019 from SIP from inception, Nifty 94, don't go to BSE, and that's all distracting, right? BSE started in 79, that's all. You will always get 16, 17% there. That's not the real return. Nifty 94, 95, when it started, till 2019, Nifty 500 is below Nifty 50. So Nifty 50 is 12 to 13, including dividends. Nifty 500 is around 10 to 11, which means collectively it underperforms by 1 or 2%. And third, add to this the flurry of IPOs which are coming, which are all offered for sale. There's no 100, 200 bagger here. It's all juiced up IPOs, right? So all of this makes me believe that only the big gets bigger. That's the India story. So stay within Nifty 50, right? That's okay. So this is limited take here. On to your, Nigel, the rupee debate, and I was surprised RBI again did the intervention last week, right? And try to hold the rupee. So the point is RBI will have to make up the mind as to what the level it is comfortable with. My sense, it should be 92 to 95 anytime. And by the way, what is there to protect? It's the export or tariff war is just about to get unleashed. It will be very competitive. China will devalue the currency. I don't know why are we getting into this tariff currency war. We'll be kind of on the receiving end of this otherwise, right? And by the way, US will negotiate tariffs. I'm sure this will be negotiated as well. So that's my limited take. But by the way, FI is not so much. Look, if they have to buy, they buy at any price. So I'm sure if the growth comes back to India, which is one view is that it's pretty cyclical and it'll come back. They will come back. They come back at any price, right? And it is just that this is just maybe 2025 is not the year, or maybe 2024 was not the year. That's how I believe on this, Nigel.
What will make you change your view, or what would make this shift from long China, long US, move back towards perhaps long India, largely because valuations have seen some bit of moderation, and we've also seen some stocks coming back into comfort zone. What are your thoughts here?
So great. So Mangalam, I think Nifty is already at a good level, by the way, right? You can't try and bottom it, right? Exactly catch the bottom, but Nifty is already right there where it should be, right? And if the earnings pan out next year, maybe 12 to 14%, I think it can anyways, hover between 22,000 to maybe 28,000, depends on the multiple, right? Real factor to watch there is what is the nominal growth in the economy. If that is more than 10% and sustains, that's good. If that suffers a bit, I think there'll be a bit of a rethink. Second is the credit growth in India. It has come to 11-12%. If RBI is able to just manage this economy in the manner that monetary policy and fiscal policy work in tandem, and the credit growth comes back to 15 to 18%, that's a thing to watch. I have always maintained a positive stance on India. It is just on the margins, where do you go underweight, overweight? Look, that's what the world does. If $100 start from US, 80, 70 go to US, 20 go to Europe, 10 go to emerging markets. Within this 10, about 2 comes to India. That's the 20% allocation. So about 1 trillion, about 20 billion goes to India. That is the long-term equation. That is how the numbers stand. On the margins, it can be 25 billion in some years. It can be 15, 10 billion in certain years. So I think we have to take this flavor, with the way it is. The bigger risk, Mangalam, if I can leave with one thought, and I was little shocked when I heard this on your channel. I think Prashant and Surbi, you were there, you were interviewing the Access Management. They said about $55 billion of IPO listing / QIP promoters selling is expected in 2025, right? On the base of, and I could see the discomfort where you were trying to prompt a question like, is this a good thing? And the answer was, well, this is a good thing as long as SIPs keep coming. I mean, this is a bit too much, right? I don't know whether that can keep going, right? And I also remember a very fantastic interview, by the way, with Sanjeev Prasad of Kotak. I think that's a very good interview, right? Almost 50% of the money, this data, by the way, is not public. And I'm, thankful to him that he made that public. 50% of the money, 45 billion, came in 2024. That is equal to 21, 22, 23 combined. Yeah. I don't know how those investors are going to behave, right? So those are the equations. I would say, Mangalam, to your question, I think that is what is facing. So FIs might be capping returns on Nifty, but that'll come eventually, right? There's no confidence gap there. Rest 450, that's the issue, right? It's the domestic selling issue that's happening. So long question.
Anurag, yeah. No, absolutely. Take your point. And I think these are ultimately it's the flow of money and the color of money, right? Till now, domestic institutions have been supporting this exodus of FPIs. How long can that continue? Well, we can only keep our fingers crossed. And on the IPO bit, I think, the IPO market has kind of sobered out already. Let's see. Market sentiment also determines the kind of issuances that we get. So we'll figure out how the next couple of months are. Thank you very much for joining in with some perspective this morning, Anurag. Well, let's quickly move on and tell you what the rest of the show is looking like. Lots of interactions lined up as always at 8:35. We will have Mr. Ashok Atluri of Zen Technologies come back to us. Remember, he was speaking to us about the defense deals with the US earlier. This time it's on Q3 earnings of the company. At 9 a.m., Nitin Agarwal of Motilal Oswal Financial Services joins in. We talk about bank earnings and what lies ahead. Is there any sense in picking bank stocks right now or not? At 9:20, Krishna Sangvi of Mahindra Manulife Investment Management is our market master of the day. At 9:30, we get chatting with the management of Cummins India, talk about the outlook ahead for the industrial segment from here on. At 9:50, Kamaljeet Saluja of Kotak Institutional Equities joins in to talk about key trends in the IT sector. And towards the end of the show, we will be in conversation with the management of Rallis India and talk about the company's Q3 performance.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, we run you through the list. We look at Bharti Airtel, ABB India, Zomato, Power Grid, GMR Airports, GR Infra, Bharat Forge, KIMS, Paytm, and DCX Systems. All of them will be reacting to positive news flow. And on a day like this, in our top 10 segment, all are expected to open up in the green. Stay with us. We'll slip into a break, get into further detail on all of these names.
Welcome back. The GIFT Nifty indicating a cut of almost 27 points at the open. Not really a worry. We did see a recovery from lows yesterday. Let's get stock specific now. Our research team is standing by with the CNBC-TV18's list of top stocks for the day. Good morning, guys. Let's go across to Sudarshan first. Sudarshan, there was a big cut on Bharti Airtel in the last hour yesterday, and now perhaps we know why. Tell us more.
That's correct. So promoter entity, that is India Continent Investments, which held 3.31% stake as of December 2021, is likely to sell nearly 1% stake via block deals today. And offer size of the deal is around rupees 8,000 crore with offer price at rupees 1658.80 per share, which is a discount of just 1% to closing price. And there will be 180-day lock-in period if this promoter entity plans to sell further stake via block deals. Now, I'm going with gain first because of the discount is just of 1%. And second, this deal is likely to happen in the block deal window. So I'm going with gain.
Okay. All right. Got it, Sudarshan. Thanks very much. So Bharti Airtel on the radar. Let's move on. We had some numbers come in yesterday. ABB India was in focus. Vivek, morning. How are the numbers?
Well, good morning. A strong beat across the board as far as ABB India is concerned. Remember, the stock has endured quite a bit of volatility in the run-up to this particular set of Q3 or Q4 C525 numbers on the back of the fact that you saw slightly muted commentary from the global parent and also kind of valuation derating that the entire capital goods sector is concerned. But the numbers are very strong. Revenue growth of almost 22%. This is driven by across the board growth in the, barring the process automation system. So growth is seeing the robotics segment, the motion segment, as well as the electronics electrification segment. So revenue beat the CNBC poll by close to 7%. The core EBITDA came in excess of 650 crore, which was a 17% beat to the CNBC-TV18 poll. EBITDA margins at 19.5%. We were working with a range of 17.8%. On the back of that, profitability beat the estimates by 15%. Now, the only blip as far as the entire results was concerned was the order inflow growth. Order inflows actually fell 14% on a year-on-year basis, but we have to remember that the base that the company was working with in terms of order inflow, the base was very strong. So excluding that, if you're looking at only the base orders that grew 4% on a year-on-year basis, company says growth led by metals and mining, energy and chemicals, electronics as well as renewables. Also, management commentary quite positive in terms of private capex too, picking up modestly, going with the green as far as ABB is concerned.
Okay, all right. Thanks a lot for that, Vivek. Mangalam, coming across to you. Zomato, tell us more.
Well, Zomato is a company, it seems like, they love to be in the news for whatever reason. Change the name, get share of, market space, get share of stomach space, get share of the screen space as well. And this time around, they've gone ahead and opened one of their internal tools for external sale as well, which is Nugget, which is an AI customer support platform for third-party use. Basically, what it does is it enables, customer service, customer support systems. It has been doing that for their own businesses.
This is what I'm talking to when I'm resolving a query, right?
So if you,
this is what it is.
If your biryani does not come to you in time, Nugget is who I'm talking to. More often than not. So it powers about 15 million plus support interactions per month for Zomato, Blinkit, and Hyperpure. It's built over 3 years as an internal tool. What Zomato's done is they said that, okay, this is successful internally. How about try and open it externally as well? So they've shown it to a bunch of companies, and the company says that 90% of the company who's seen Nugget, they've signed up. We don't know how many of the companies have seen it. And secondly, they've said the first launch has come in from their in-house incubator. More coming soon. Will this be as big as Blinkit? Will this be as big as Zomato itself? Perhaps not. But what does it do? It keeps some money coming in for the company. So not a bad deal if you're leveraging some of your own internal tools. So mild green is what I'm going for with Zomato.
All right, and talking about it staying in the news, let's see the Nifty rejig as well will be announced. So let's see whether or not it does make it. But going back to Vivek, tell us about some more stocks and news.
Well, that's right. Quite a few stocks in focus on the back of news flow that came in post-market hours yesterday. First on the list is Power Grid. The company has emerged as a successful bidder under the tariff-based competitive bidding. This is for 2 projects to establish interstate transmission systems. One project is in Karnataka and the other project is in Rajasthan. GMR Airports, the company gave its operational updates for the month of January. Passenger traffic is up 11% on a year-on-year basis, but December being a stronger month, you actually saw January volumes dip 2% on a month-on-month basis. January domestic passenger traffic up 11%, international passenger traffic up 12.4%. Aircraft movement was up 9% on a year-on-year basis, and again, on a month-on-month basis, went down 1%. The other stock on the radar is GR Infra. The Madhya Pradesh highway project that was constructed under the hybrid annuity mode has been completed. The project is fit for commercial operations from Feb 1st. Remember, the bid project cost was close to 907 crores, so positive news flow for all 3 of these companies.
Okay, all right, sounds good. Thanks very much, Vivek, for that. Let's go back to Sudarshan. He's watching out for a couple of other stocks as well. Sud, which ones are these?
So I have 4 stocks. We'll start with Bharat Forge. It has launched mobile gun system on 4x4 all-terrain platform, and the range is beyond 36 kilometers, and deployment time during the day is 1.5 minutes, and during the night deployment time is 2 minutes. KIMS, it has entered into a strategic partnership with Usha Kal Abhinav Institute of Medical Sciences located at Sangli, Maharashtra. Also, KIMS will have an option to acquire majority stake in the UAIMS in coming years. Paytm, its subsidiary Paytm Services, partners SBI Mutual Fund to launch Jan Nivesh with an option of rupees 250 SIP, and it also provides flexible SIP options of daily, monthly or weekly. Last one is DCX Systems. Company has bagged domestic and export orders of 24.51 crore rupees, and these orders are for manufacturing and supplying cable and wire harness assembly, and companies awarding projects include BL and Rafale Advanced Systems. Israel. So keep an eye on these stocks.
Okay, all right. So thanks a lot for that. Well, here's a quick recap of all the stocks we just discussed, and all of them are with positive news flow. Bharti Airtel, ABB India, Zomato, Power Grid, GMR Airports, GR Infra, Bharat Forge, KIMS, Paytm, and DCX Systems. All of them reacting to positive news flow. But that's about the equity markets. Manisha Gupta joins us to tell us about the commodity space. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, after yesterday's gains, we are looking at the crude oil prices holding above $75 a barrel right now. There are two reasons to that. One, the oil market is supported by reports that OPEC and allies are considering delaying a series of monthly supply increases going forward. And the second is there are reports that Ukrainian drones have struck a major pumping station of a pipeline in southern Russia on Monday, disrupting oil flows from Kazakhstan. So these are a couple of factors which really seem to be supporting crude oil prices. In the meanwhile, you have gold also rising back above $2,900 an ounce. It's a second straight day of gains coming in for gold prices also. The risk of market disruptions due to U.S. tariffs, the decline in U.S. dollar seem to be supportive not just gold but for silver prices as well in the Asian markets right now.
All right, Manisha, thanks a lot for that. That's something we'll most definitely keep an eye out on. With that, take a short break, come back on the other side. We will have Amnish Agarwal of Prabhudas Lilladher Capital for some fundamental stock talk. Stay with us. Welcome back. You're watching us here on Bazaar Morning Call. Not materially changed for the gift nifty of the last few minutes. But let's see what the market holds for today. A couple of stocks on our radar, like we pointed out earlier. Amnish Agarwal, who's the Director, Institutional Research at Prabhudas Lilladher Capital, now joins in. Good morning, Amnish. Two stocks on our radar. One is Bharti Airtel on account of that large block deal. The other one is Zomato on account of them opening up one of their internal tools for external sales as well. On both these stocks, your thoughts?
Yeah. Hi, Mangalam. First on your Bharti Airtel. You see, in many companies, we have seen that the promoters have been, you can say, pruning some stake here or there. So I think looking at the way the financials of the company are panning out, and today, I think telecom is the most vibrant thing, and the business model looks very sustainable. And with the lag impact of the tariff hikes, which happened last year, is yet to play out fully. I think the next couple of quarters also should show very strong numbers from Bharti Airtel. So I think the offer is likely to be lapped up very easily, I think, and Bharti remains one of the top stocks as far as your telecom. And even if you look at, say, in case of, say, discretionary spending also, I think Bharti Airtel, you can say, ranks among the top companies today. Now, secondly, coming on to Zomato, you see, Zomato, we will have to see what the new, you can say, app or the tools which they are now opening up for the external people, how much, you can say, they can contribute over a period of time. But having said that, Zomato is always looking to enter, say, new segments. Suffice to say, today the major value for the company is getting created from Blinkit, which was an external acquisition, followed by their food delivery business. So while it is a positive, I don't think market is going to react anything in a very major way to this development, because we have got very limited, you can say, idea about these tools as of now and the scalability of the same.
Okay, all right. Amnish, request you to stay with us. For the time being, we need to get to a conversation with the Zen Tech management. Mr. Ashok Atluri, the chairman and MD of Zen Technologies, joins us on the show. Hi, Mr. Atluri. Well, the markets didn't like the numbers, and that's why the stock was down 20% yesterday. And from the peak, it has halved. But let's get a couple of questions out of the way. First up, in terms of the financials, earlier you were talking about around 900 crores of revenues with approximately 35% of margins and your receivable days coming down. Do you think that you're on track for all of this? And the working capital cycle is very, very important, sir, because, the cash from operations as well have been very, very bleak. So please confirm these details. Mr. Atluri, you're on mute, sir. Our viewers, your shareholders are waiting to hear you.
Yeah, 900 crore, we are on track, Nigel. And with respect to the working capital days, we are thinking that it will stabilize around 200 days on overall year basis. So otherwise, everything is good. We think there is a slowing down in the orders received from the government, and we think the orders should pick up in the Q4 and Q1. So we are looking forward to that.
Okay, all right. So 900 crores of revenues, working capital days at around 200 days, and margins at around 35%. All three numbers is confirmed, right?
Yes.
All right, Mr. Atluri, before we get into further details, when a stock runs up big time, the street is very, very happy. But when it falls, they want to see the largest stakeholder come in there and give some support. Now, your shares, your holding in the company, from around, I think, 60% because of dilution, etc., it's come down. The last reported number, I think, is a little below 50%, at around 49%. With the kind of fall that you've seen in the stock price, and given that you believe that the company is still on that growth path, would you come in there and try to support and maybe find the stock attractive enough and back up the stock, pick up some stake and increase it from around 49%, say, take it back to around 50%? Is that a thought process in your mind?
So there is no such thought process now, Nigel. The reason is that, we diluted, the dilution has been mostly done because of the QIP that we did. We did sell, we did sell 4% of our stake, on 2 occasions. But the dilution has mostly been because we raised the money for acquisitions and working capital needs. So, I don't think we will be entering the market to buy it, because the intention was not to trade sell high and buy low. The intention was we wanted to have some money on the table. So that was the reason, yeah.
That brings us to our next question, which is the acquisitions that you have made or the acquisitions that you've announced along with your results itself. I look at some of the numbers. You've bought Applied Research for about 127 crores. Out there, the revenue is 92 crores. You've invested about 4 crores in Bhairav Robotics, no revenue. You've invested about 25 crores for 51% in Vector Technologies. Here as well, absolutely no revenue. Nearly 13,000 rupees is what you reported in the last financial year. So what one wants to understand is what is the scalability in terms of revenue for these acquisitions, and are they margin accretive? If not, then by when?
So ARI is in the business of naval simulation, and we are very. I think it's almost like a twin for Zen. Zen has been very dominant in the army simulation, and ARI has been dominant in the marine simulation, not in the naval simulation. Now, difference between marine and naval is that naval simulation also require weapon systems, etc., as an addition to make them transfer from marine to naval, and Zen has those weapon systems simulators with them, or they can be achieved very easily. So this will be a completely new market that we will be addressing in a big way. Actually, about 15-20% is already from Navy for ARI. But this is an extraordinarily, opportune moment for us to invest in this company. And we have been saying that we want to get into Navy. And this
Could you give us a sense of how much bigger can it be? It's 92 crore as of the last financial year. You've paid 127 crore for this business. How much bigger can this be over the next 1-2 years? What margins are you targeting here? And on the others as well, Vector and Bhairav, when do they become revenue accretive? Because you've paid a fair amount for them, together close to around 30 crores.
So with respect to by 27, I think it should at least double. The revenue should at least double for ARI. That's our expectation. And
margins of?
Margin, I think it should get to the margin of 35 EBITDA and 25 net. Even though now it's around 13-14%, we expect that to ramp up, especially when we go with our value addition.
And what about the other 2 acquisitions, sir? You mentioned that revenues for this one. Yeah.
So, but the Vector is a very, very rare company in the sense that they actually make the BLDC motors. They make the engines. They make the counter rotary propellers. So this company, Zen looks not at the turnover, but at the potential and the IP that they have developed. The IP this company has developed is extraordinary, and we think that this is a absolutely win-win position for us in the sense that not only will they be helping Indian drone companies to indigenize, but they'll be also exporting a lot from here to North America and Europe.
Okay, so you've bought it for the IPs. Got it. All right, sir. Coming back to the overall question, the guidance you've already reiterated that you will do 900 crores in FY25, right? And you're saying that revenue from at least ARI, some of these other acquisitions should start trickling in. So what is the top line growth expectation that one can have for FY26 from Zentech?
So, I think for FY20, again, we have been saying that there will be a CAGR of 50% over the next 3 years, average CAGR of 50%. So depending on the inflows of the order in Q4 and Q1, we will be able to actually predict what will be the, top line for Zen in 26. But we expect a law, even if it is muted, we expect that the 27 and 28 will more than make up the gap in terms of absolute number that we are planning to achieve.
So you're saying 50% CAGR top line, you're still intact with that sort of outlook and guidance?
On an average. Even if this year is a little shortfall, we'll try to cover it in 27.
Okay. Now, on margins, I think you've mentioned that you will be around this 30% handle. Just trying to understand what's happening, because you've already done these acquisitions. So, how much cash is left in the books, and why did your finance cost go up so much in the third quarter?
So, the finance cost, we had taken, a loan from an NBFC preemptively, but it was a 10% cost. So the cost that has gone up is because of the interest on that, but it was 60 crores because by that time QIP was not done. So in anticipation of delays of QIP, we had raised some money. But this will be repaid by this May, and so we'll not be having any finance cost in that regard.
Okay, all right. Very quickly, sir, what is the pipeline you have bid for orders? Because currently, I think your order book is around 800-900 crores approximately, and you're expecting things to pick up in the first half of next fiscal. So what is the pipeline of the orders you have bid for? Because that will give us some visibility, sir.
So I would say, the pipeline, we say whenever the fund allocation happens, etc., we think by the first quarter, almost about 800 crores worth of orders would have been decided.
All right. And these acquisitions that you made for the IPs, does that enable you to bid for more? If you could give us a sense of, by when do you start bidding for projects from these acquisitions that you've made?
So ARI, we will start bidding immediately. I mean, as we speak, we will be going and start talking to the navies, not only India, but all global navies about, the capabilities. And again, we want to be absolutely aiming to be number one in that. And I think the revenues should start in FY26, but I think they'll really accelerate in FY27 and 28.
Okay, all right, Mr. Atluri, thanks a lot for joining in and clarifying on all of those details. For the last 1 month, your shareholders have been clearly nervous. The market has been such as well, but your stock price has come off by close to around half. And even now, it's at around 10,000 crores of market capitalization. So execution of orders, getting more orders, and reporting a good amount of profitability is something that the street will track very closely. Thanks a lot for joining in. Amnish Agarwal is still with us. Amnish, thanks a lot for staying by. Tell us about your view on the defense stocks. A lot of them have come off the top. What's your top buys out there? And any view on Zen Technologies? Would you be interested? The management has been talking about a very, very good order pipeline. Though delivery could be a little bit short in the near term, though they're talking about 50% CAGR growth over the next 3 years. Would you be interested?
You see, we haven't done any detailed work on Zentech per se, so I won't be in a position to give my views on the same. As regards the other defense stocks are concerned, I think the outlook on them seems to be quite good because the ordering has improved considerably over the past few months. And the way the government is looking at, say, ramping up the, production in the domestic sector, I think that actually gives a very good visibility of growth. Having said that, what actually happens is that many of these defense projects, whether it is, your Tejas orders for HAL or some of these submarines or frigate orders which come for some of these, Mazgan Dock or your shipyard, other these companies. Now, some of these are very long gestation projects. In some of these, for example, in the first 3-4 years, you will be booking just around say 40% of the revenues, and maybe in the 5th or 6th year, the full revenues will come. Now, whether these companies will grow, the answer is yes. Can the growth be a structural 25-30% kind of a number in top line? I don't think that is the way these companies operate. So whenever the booking of any large order gets completed in terms of execution, then you will see, more execution and numbers coming in. But having said that, many of these stocks have now corrected to much more reasonable levels. For example, within the ambit of some of the stocks we cover, Bharat Electronics is one such stock where The stock has corrected from 340, 350 levels. It is now trading at maybe around, say, 30 or sub 30 times FY27 numbers. And the advantage is that it caters to all the armed forces, whether it is your Army, Navy, or Air Force. The execution is strong, and the track record in terms of listing and delivering to shareholders is there from the last 30 years. So Bharat Electronics remains our pick in the space. But having said that, some of the other names also will, I think, they look good in the long term, and particularly so because they have now seen significant correction. But one should not expect the kind of return we have seen in the past. But I think a slow and steady climb from the lower levels can be witnessed in some of the defense stocks. So I think there is no reason to be, you can say, negative, but yes, one needs to be very selective in picking these names now.
Okay, fair point. Amnish, got that. Thank you very much. Stay on. We'll have some more questions for you in a bit. As we take the break, should look at the Hong Kong market once again. Just can't take your eye off on it. Started quiet. Remember, there was a 3% rally in Hong Kong, 3.5% on Friday in anticipation of this Xi Jinping meeting. The meeting happened, and now there's fresh exuberance, 1.5% up out there on the Hang Seng. We'll take a break, come back. We'll also have our technical experts join in. Sudarshan Sakhani and Mitesh Thakkar will join in with some trading perspective.
Welcome back. You're tuned into Bazaar Morning Call, and we have our technical experts who join us, Sudarshan Sakhani as well as Mitesh Thakkar. They are on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, before we come to you, just want to alert our viewers that large trade has taken place, 3.5 crore shares worth of around 5,800 crores. That's changed hands in the block window. If you saw the stock yesterday, towards the end of trade, there were a lot of shots that got into the system. Now this has taken place in the block window, and also we know there is a lock-in for 180 days. So some of those shots, they'll be scrambling for cover. Bharti Airtel could be the stock of the morning that will pop up well in the green because it's taken place in the block window. But coming back to you all, Sudarshan as well as Mitesh, thanks a lot for joining in. Well, Mitesh, you go first. Tell us about the Nifty, bottom, double bottom, triple bottom, quadruple bottom, 22,750, 22,700. Will it hold or is it set to break?
Good morning, Nigel. So I think, my initial feeling is that there's a chance that it might hold, despite the fact that we have done more than 3 attempts. The reason being is that a lot of indicators, which were declining because of this multiple times the market has taken support around this area have stopped falling. They've started turning flat. Now, the only thing is that if they can start turning up, then we might have a slightly better price action scenario. So I hope that this 22,800, 750 levels holds. And once that happens, and once we get a reversal sign, which could be a closing about 23,150 at least, that will give you a short-term reversal. Then we might, see that there is some base building which could lead to a reversal, and we could get into some kind of an uptrend. But for the timing, I think I'm just keeping my fingers crossed that this level, despite the fact that it's being tested multiple times, is managing to hold on, and I hope it continues.
All right, let's take the same question to Sudarshan as well. Sudarshan, when a door is knocked at multiple times, chances are that people either leave from the door or that door opens. What side are you on right now?
Good morning. See, yesterday the Nifty made new lows and it bounced from that. But the fact remains that new lows for this bear market were made. And that's not good news. The bounce could be anything. It could be a dead cat bounce. It could be the beginning of a new bull market. But it's too early to say. So we'll just have to assume that the downtrend that had started, or we can call it a deep correction, that correction continues, and these bounces are just normal in an ongoing trend. Whether it was up or down, we are in a downtrend, and we will see those small corrections on the upside. So at some point, I hope we will all be proved wrong, and the market will really take off, but today is not the day. So the trade for today remains the same as yesterday. It's best to avoid the index.
Got it. Best to avoid the index. And let's talk about individual stocks. Sudarshan, you go first. What do you have on your radar?
Well, Nigel, this is also a problem. A lot of stocks are giving sell signals. I wish, again, that I had a big buy list, but I don't have it. So that's one of the themes that at least the mid-caps are getting crushed, mid-caps and small caps. Bada India is an intraday short with a stop above 1320. Supreme Industries is again a short with a stop above 3,700, and SAIL, a third stop short idea, with a stop above 108. So just to balance it and make it cheerful, I have SBI Life, which is a positional buy. I mean, intraday it could do anything. SBI Life is giving some signs of life. I consider a positional buy with a stop under 1445. Broadly,
All right.
it's still a sell market.
Okay, largely a sell market. 3 short ideas and 1 long idea to balance that out, and that to a positional one. We'll keep an eye out on that, Sudarshan. Mitesh, your stock ideas?
I have a few more buy ideas. Ashok Leyland was a recommendation yesterday as well. Is a fresh buy with a stop at 218 for targets of 235. Hindalco is something which I like. So if it starts getting past yesterday's high of 612, buy with a stop at 602 for a target of 635. Also buy on ABB with a stop at 5190 for targets of 5350. And KPIT Tech is a sell call with a stop at 1336. Look for targets of 1255.
All right, gentlemen, thank you for joining in. We'll come back to you soon. For now, we take a short break. Come back. On the other side, we have the pre-opening, and also Nitin Agarwal of Motilal Oswal Financial Services joins in to review the third quarter earnings of banks. Welcome back. You're watching us here on Bazaar Open Exchange, live from the CNBC-TV18 Motilal Oswal studio. Quick look at the Asian markets. The Hang Seng continues to hold well. It's about 1.5% higher, and we have the Taiwanese index as well, about 0.1%. Has that done anything to the gift Nifty? Not much. When we wrapped up 5 minutes ago on the previous segment, we saw the gift Nifty down about 31 points. Now it's down about 33 odd points itself, though all eyes will be on what happens in that famous meeting, between the Chinese, the government and the corporates, and what comes out of that. Because if that's a positive, then that may be India negative, because a lot of money, everyone is talking about going to China.
See, a lot of people attended, and then you have to attend. You can't say no when you know the Chinese president is there. But the fact that Xiaomi, Huawei, there was Meituan, BYD was there. So, I mean, all the big giants were there. Jack Ma himself showed up. So, I think it was this big confidence-boosting measure. And then you had a release come out of it. I mean, the visuals that we're seeing, it was all very well organized to send out a message. And that message seems to be that China is open for business, and the government wants to, again, I mean, to reiterate that quote that I had put up earlier, that, unplanned, random seizures and checks, they should not sort of take away the confidence. That seemed to be the message, and it's a message that's being very well received by the markets.
Reminds me of a Bollywood scene, where both US and India are saying, I have earnings, I have demographic dividend, I have, Donald Trump right now, I have tariffs. So what do you have, China? The Chinese government says, Mere paas?
Jack Ma hai. All right, let's take things forward and now come back home, because while that's the buzz around China, the fact is that we're looking at the earnings season that's just concluded. It's not been a very blockbuster, so to speak, earnings season at all. Let's put the spotlight specifically on the financial space and talk about what lies ahead. Q3 was fairly modest for the BFSI space as well. But now what is FY26 looking like? What are we in for, considering the rate cut cycle has just begun here in India? Nitin Agarwal, who's head of BFSI research at Motilal Oswal Institutional Equities, is with us. Thanks very much for joining in, Nitin. So that's the real question. As these rate cuts get underway, what can we expect? We've seen a little bit of a hiccup in asset quality. MFI issues are still persisting, but NBFCs went ahead and met the governor, and there's hope that they'll have better and easier access to funds. So let's start with your big picture in terms of, if you were to look at buying or adding to any BFSI positions, what is looking the best to you?
Yeah. So good morning, Subhi. Yes, with the start of the rate cut now, we will see a further sort of compression in bank margins. While a large part of it has already played, as the funding cost kept on rising over the last year. But as now the lending yield also reprices and the loans which are linked to repo rate reprices down, there will be some incremental pressure on margins that we will see in the coming quarters. And depending on how and at what pace RBI moves, I think bank NIMs will be linked to that extent. And NBFCs, on the other hand, select NBFCs, especially the ones who are in the vehicle business, will likely see NIM expansion because their large part of their borrowings comes from by way of banks, and as their funding cost comes down, they will likely see a uptick in their NIMs in the coming year or coming quarters, I will say. And but it will be for select NBFCs, I think, because especially for say housing finance companies, if you look at, I think they may still continue to see some NIM pressures, and the picture may remain mixed there. But for passenger vehicle players and the CV players, I think there is a good case of NIM expansion to play out over the year.
All right. Hi, Nitin. Good morning and good to see you, Win. Let's focus on Kotak. Yesterday we had an exclusive chat. The top boss out there, Mr. Vasmani, had a chat with our top boss, Shreen. And what he said was, with the launch of 811, he hoped to add close to 4 to 5 lakh customers a month. Do you think that number is something that you would be working with as well, or do you think he's being too ambitious?
I think yes, because see, Kotak has lived through this ban over the last 1 year. They navigated along still pretty well and handled all the uncertainties and still delivered a pretty reasonably good growth overall. And now with the ban getting lifted, I think the team overall is quite energized and looking to go for it and make up for the loss that they have seen in the past 1 year, because the market share in credit card has come down quite meaningfully. And now with the renewed focus on growing the consumer business, they have already done some acquisitions. And in the card space, while the overall markets are still not very conducive when it comes to unsecured loans, but Kotak, having not been able to grow in this kind of market, was kind of a blessing in disguise, I'll say. And to that extent, now as they come back fully in the market and look to grow the unsecured portfolio, I think the bank is better positioned to deliver stronger growth versus many other private names. So we have also upgraded Kotak alongside the 3Q results.
All right, so you've upgraded Kotak. So let's get stock specific now. Nitin, with the kind of results that you've seen in the third quarter and the kind of environment that we are in right now, where do you see maximum credit growth coming in? Which companies stood out in the third quarter results for better performance over the next few quarters? And from an industry standpoint, what is your expectation on credit growth and asset quality?
Yeah. So, Mangalam, we are looking at overall around 10.5-11% kind of industry growth for this year. And even for next year, I think the numbers will be only slightly better, somewhere around 11.5 to 12 is what we are looking at when it comes to credit growth. And deposits is something that continues to remain a challenge for the overall sector. And the CD ratios for many banks still remains elevated. Even PSU banks are now looking at a fairly optimized balance sheet, and CD ratio for many of them have approached 75. And few banks like Bank of Baroda are already in early 80s. So to that extent, I think deposits will continue to guide loan growth, while at the margin, given the regulatory steps in terms of the reduced repo rate, and which will continue likely, and alongside the measures on the budget that the government has announced, may spur some demand on the consumer side. But the actual translation of that in terms of growth, I think, will still be relatively controlled. And to that extent, we are expecting only a slight uptick in FY26 growth numbers over FY25. And when it comes to stock, I think large banks are doing relatively much better in this part of the cycle, while NIM compression is playing out, but that pace has come down very meaningfully. And on the asset quality side, the larger banks, like you look at ICICI, HDFC, they're all reporting very stable trends. So the pain that we are seeing is very much limited to the unsecured segments, and within that, the MFI and credit card. And it's only impacting the select mid-sized banks and those players. And I think these trends are likely to continue, while overall credit costs will see some uptick, but we are penciling in a calibrated upticks over there. And to that extent, ROAs will still remain fairly healthy for the large banks. And that's where our preference lies in the current markets.
Okay, so Gaurav, that explains why you like stocks like ICICI Bank, HDFC Bank. I think these are some of your large cap picks. On NBFCs, Nitin, you mentioned that some select NBFCs could actually see, that pressure on NIMs to come off. Maybe NIMs even improve, are you saying? Which ones would this be? Would Bajaj Finance make the cut? Essentially, what are you buying in NBFCs?
I think, vehicle financiers looks interesting because the valuations overall are quite reasonable for them. And now with the way the utilization levels are expected to move up, and in respect to the demand that is going to see some recovery, and alongside the funding costs, which will come down, because for these vehicles happen by way of banks, borrowing from the banks, and that interest rate will come down and linked to the repo, and therefore players like Shriram, Chola may see some recovery in margins over the year. And these are the, Shriram is one name, MMFS is another name that we like a lot in the vehicle space. So Shriram, MMFS are the names that we like.
Okay, so Shriram and Mahindra Financial as well. Final question, Nitin. I mean, we've seen the MFI stress, and you're saying probably the worst of it is has played out or is playing out now in the fourth quarter. Is there any other pocket in tier 2 banking as well? Any other accidents that we need to be watchful of, potential accidents? Because all the banks you named are the pristine quality A-grade banks. What about tier 2 lenders and anything else? Any other red flags on the horizon?
I think, see, MFI as a space still continues to face the headwinds. We are still not fully out of it. And once the new guardrails comes into effect from the next quarter, we will still need to see how the industry takes up to that, how the borrower behavior is, and what kind of growth rate are we really looking at. So possibly the stress and the elevated credit costs will continue for a couple of more quarters. And hopefully from second quarter of 26, you will see the normalcy returning to the sector. And while there has been an improvement in collection efficiencies across states on a month-on-month basis, but this is still not good enough to take them home. And to that extent, I think the overall slippages and the credit cost will remain elevated. And it will take time for the sector to come out of it, and because there are very acute problems of over-leveraging. And this guardrail-related impact is something out there which also needs to be watched out for.
Right, Nitin, thank you so much for joining in. Always a pleasure speaking with you. With that, let's look at a couple of these stocks which are settling well in pre-open. ABB India is top of the pops, up nearly 4% in pre-open itself. There was a beat across the board when the company reported its results yesterday post-markets. Vivek joins in once again to take us through the numbers. Vivek.
That's right. You put it right. It's a beat across the board. Revenue strong, almost 7% beat versus estimates. What drove the revenues higher? The robotics division up 30%, motion division up 22%, and electrification up well in the almost mid-30s. EBITDA coming in at 657 crore, which is a 58% year-on-year jump. 17% beat to the estimates. EBITDA margins beating the estimates by almost 200 basis points. Profitability beating estimates by 15%. Like we mentioned earlier, the only blip in the results was a slightly muted order inflow. But remember, it comes off a much lower base. So order inflows actually fell 14% on a year-on-year basis. But excluding the large base order, you actually saw a 4% growth as far as order inflow was concerned. Growth the company saves was led by metals and mining, energy and chemicals, electronics, renewables. Stock looking to open up in the green. Interesting to see whether the street looks beyond the order inflow blip.
Okay, all right. Got it, Sudarshan. Thanks very much. Let's revisit Bharti Airtel as well, because that block did take place, like Sudarshan was alerting us. And Bharti is actually, in the pre-open, it's up about 1% or so. So let's revisit the details.
So Bharti Airtel saw a change of hands for more than 5.1 crore shares in block deal window, and that shares were worth rupees 8,480 crores. So entire block deal that company was planned to sell via India Continental Investments, that is a promoter entity which held 3.31% stake as of December 2021. So the term sheet that CNBC-TV18 had an access to indicates that this promoter entity is likely to have sold 0.8% of its total holding of 3.31% stake in today's block deal window. So yesterday, Bharti Airtel, because of this news, was under pressure. But today, we are expecting a green start for Bharti Airtel.
Green start for Bharti Airtel. Sudarshan, thank you so much for that. So that's from one suit. Let's go across to the other one. Sudarshan Sukhani joins in now. It's 9:10, the time for the 9:10 call. Sudarshan, what do you have on your radar?
Yeah. Here it is. SBI Life is a buying opportunity with a stop under 1445. Make it a positional trade.
And Mitesh?
I'll go with a buy on Hindalco in case it starts trading above yesterday's high of 612. Buy with a stop at 602.
Okay. All right, gentlemen. Thank you very much for that. Now, before we get to the market open, Nigel has hopped across to the wall to take stock of a lot of the commentary that's trickling in, given the market correction, the fact that we're just finishing up our earnings season. So what lies ahead for the Indian market? Nigel, tell us.
Well, let's get you what the top voices are saying. Let's start off with Rhythm Desai of Morgan Stanley, who's the most bullish of the lot. He says that Q3 earnings growth was sequentially better than subdued expectations. He says that the market looks good for a near-term bottom, given the improving growth. That's provided global cues do not surprise negatively. India, he says, could resume its outperformance in comparison to emerging markets rather soon. They're also overweight on L&T, Bajaj Finance, ICICI Bank, Mahindra & Mahindra, Titan, Trent, Maruti, while they're underweight on Aicha, RBL Bank, Wipro, Concor. Moving to Surendra Goel of Citi, he says that the headline trends in Q3 missed expectations with EBITDA growth of around 7% on a year-on-year basis. But he goes on to add, with a pickup in central government capex in the past few months, the budgetary support to consumption, and with the start of rate cuts, they expect growth to pick up. But the impact of the reciprocal tariffs from the United States, that's something that needs to be watched out for with regard to its impact on select sectors. After a 12% decline, though, from the peak, they believe that valuations at around 19 times 1 year forward is below the 5-year long-term averages. And the FIIs, they're underweight on the benchmark, which is at the highest levels we have seen in the last 15 years. He goes on to add that India looks relatively well placed post the correction, and their December 25 Nifty target is roughly around that 26,000 odd mark. So those are a couple of big market voices that we got earlier. During the course of the day, we'll get you a few more voices as well.
Okay, all right, Nigel, thank you very much for that. So there's some interesting views there coming in on the market. By the way, the pre-open is absolutely flat. There's nothing much moving, but like we've been saying, maybe flat is not such a bad thing after the brutal fall. If we can just spend some days in consolidation, the bulls will take that also with both hands. Let's check some of the trend stocks that are, showing some green, flashing some green. Bharti Airtel is one for sure. There's Adani Enterprises, Grasim, Aisha, and M&M. The pre-open is suggesting that the M&M will see some stability after yesterday's 4% dropping. So let's see how it goes. Mangalam, you're watching for anything? I wonder how is Zomato with Nugget, which they're the nuggets that they're going to offer to the rest of the world now.
Just a nugget of a game. Again, see, about 2/3% is what we're seeing on Zomato. The pre-open comes up for you. Again, imagine a food delivery company going into, or rather a food delivery / quick commerce / outgoing event sort of company now going into B2B SaaS. That wasn't on anyone's
Suddenly they're a software company.
Checklist. And maybe that's also the reason why they want to, go beyond Zomato and turn into Eternal. Because they want to be a bouquet of offerings and not just a couple of apps itself. But what's actually catching my attention is Senco, which has seen a big cut over the last few trading sessions, largely on account of weak numbers. This month itself, the stock is down 28%, from its highs down about 56%. It had peaked when the company raised money via QIP. Now it's seeing some signs of life, up around 3.5% in pre-open. Westlife Food, remember we were talking about how there could be some hope coming in terms of recovery for the quick service restaurants. Westlife Food, again, has seen a big cut at pre-open, up around 9%. How much of that is pre-open fun and games is something that we'll know only when the market opens.
Yeah, volume is very low
right now. No volumes, 115 odd shares. So that's something we'll keep an eye out on. But then ABB India definitely top of the pops. High volumes, good numbers coming.
Just one more stock, Max Health. There's a big upgrade that's coming from UBS. I think earlier the target price was 610. Now the target price is at around 1200 odd. So that's a big U-turn. They have upgraded the stock to buy from neutral. So we can keep an eye out on that one. Could explain why. On decent volumes in pre-open, the stock is up closer to around 3%. But I think we've got a few seconds. Let's get straight to all the rates we're getting in. As the markets open up. So, take it away. Tell us about the Nifty levels first.
Okay, flat is the start. That's what we're getting. Actually, flat across the indices. Nifty, mid-cap, Bank Nifty, everything is flat. And now as we start getting in the first rates, about 4 to 5 points up on the Nifty. It's already flashing a little bit of red. Okay, let's see. Talking about the gainers. Grasim, Bharti Airtel, Aisha Motors. There's some green on Apollo Hospitals, but the green is very quickly going away and the Nifty is now down 20 points. So let's see what's pulling up the downside or pulling down the downside. Power Grid, M&M is again down 1%. That's interesting. M&M is now again the biggest Nifty loser this morning as well. There's BPCL, there is Bajaj Finserv, there's Ultratech Cement, Titan is a little weak, ONGC is a little down. No trends really, it's all over the place. The only interesting stock is Mahindra & Mahindra. That's follow through selling second day running. And on the upside, there is Bharti Airtel after that block. It's up in about 1% higher. And that's about it. There's a bit of obviously a defensive color to the market. So Wipro, Apollo Hospitals, Cipla, Sun Pharma, these are your names. The banks are sitting on the fence right now. Axis around 0.25% higher, ICICI at the flat line. So let's see. Bank Nifty is very, very quiet. I'll just end up with HDFC Bank, which is also very flat. No clear trends on the Nifty. Watch out for the selling on Mahindra and Mahindra. Guys?
Well, one stock from the broader markets that's taking it hard is Borosil. The stock is down close to around 15%, 18% I think so. So just keep an eye out on that one. I'm not sure whether it's numbers or something else that came about on that one. But volume's fairly high. That's down. The other couple of names that are lower, Best Agro, that's another stock that's down close to around 8%. Techno Electric is down close to around 7%. Volume's decent on all these names. And Zen Technology has said that all is well and they're expecting things to improve from here on, and they're expecting that 900 crores of a revenue target that they'd given earlier this year. But that stock is down another 5%. A few stocks that are doing well, TVS Supply Chain, that stock is up close to around 5%. Volume's fairly decent out there. Borosil Renewables, that is up close to around 5%. So both of them going in opposite directions, and we'll have the management of Borosil Renewables in the next hour or so on Chartbusters to detail their numbers. All cargo terminals as well has opened up well in the green. So the start is more or less flattish on the headline index, but a lot of stocks actually are moving around, and some of them in terms of the top volume movers today. Zen Technology tops the list. RVNL is a little bit lower. Z Entertainment, that's up close to around 1.5% to around 2%. And I think Piramal Pharma as well, another one that's a little bit higher. Mangalam?
I'm looking at ABB India. We looked at the stock, and pre-open as well, up around 3.5–4%. Right now, holding with gains of about 3%. Interestingly, Max Healthcare, which was holding well in pre-open and opened well as well, has seen some sell-off from the highs. Currently back in the red. Persistent Systems and a couple of these mid-cap IT names doing extremely well. Persistent Systems is one of them. First Source is the other one. Both of them seeing some traction. Siemens on the back of perhaps ABB or not. Maybe, some of these capex names doing relatively better. Varun Beverages is the other one that I'm looking at as well, up around 1.5% at the open itself. I'm just trying to see what some of these brewery names are doing. United Breweries is up around 0.5%. Remember, the company was sanguine on the prospects of demand going forward, with EBITDA margins seeing some bit of recovery, largely on account of the price action that took place in Telangana. So whether that continues or not is something we will most definitely keep an eye out on. AB Fashion and Retail is the other one, which continues to gain after a decent set of their third quarter numbers. So ABI Fashion and Retail holding with a gain of about 0.5%. But right now, as we speak, all the frontline indices firmly in the red. The mid-cap index by a smidge, the Nifty Bank by 0.25%, the Nifty and the Sensex by about 1/5%.
A couple of textile/apparel stocks are looking up. So there is, I saw Gokuldas Exports flash by somewhere, was 5% higher. There's Raymond Lifestyle, which is up about 4% as well. And Trent in the pre-open was up. I don't know if we can get Trent up on the screen again. No, not Trent, Trident, beg your pardon. Yeah, that's Trent. Trident is the stock that I was looking out for. So some of these stocks are a little bit of green. We'll actually discuss this in more detail. A lot of them are export-oriented companies, large exporters. What lies ahead for them if we're getting into these big tariff negotiations with the US? But that later. Right now, we get into the market conversation. Our market master of the day is Krishna Sanghvi, Chief Investment Officer, Equities at Mahindra Manulife Investment Management. Krishna, thank you very much for joining in. Welcome to the show. And it's been a tough last couple of weeks and months, right? The simple question to you to start off with, do you think the market is in the process of making some sort of a bottom? Or would that be, too much of conjecture at this point in time? What's your sense?
Yeah, I think it's too early to judge, because let's look at the dynamics of market first playing out really, right? We're looking at a large amount of selling by foreign investors, as well as large amount of money raised by listed companies or maybe to be listed companies via IPOs. So somewhere that supply dynamics of the market has taken a change vis-a-vis what we were used to in last maybe overall 2 years period. If you look at last 4 months have undergone this change, and we need to worry about that from a market dynamics perspective. I think as far as economy is concerned, reasonably on track, that 6.5% GDP. Yeah, we were possibly going to clock a bit lower than what the number was at the beginning of the year in terms of FY25. But some of those, deviations are likely in this geopolitics world where too many things happening outside India, outside our own comfort zone. Plus, some marginal hits and misses on companies. So I think that the real challenge in last 4 months period for market has been, how the supply side of the market has caught up vis-a-vis, the demand. So we not really sure in terms of, how that incremental selling can happen, because, especially for FPIs, they do look at India as one of the countries to invest. They have their own, opportunities or options to evaluate vis-a-vis some other emerging markets or even some developed markets also.
All right. Hi, Krishna. Good morning and good to see you. But Krishna, do you think that we are closer to the bottom? There was exuberance that played out. That's why we went dancing away, both the headline index and the broader markets as well. But do you think, going by the RBI action, the government as well, they've laid out a good outline with regard to the consumption picking up in the second half of the year. Capex is picking up on ground. And these are various indicators that indicate that the economy is doing okay. The markets are, in a bit of a flux. So do you think, putting all this in the backdrop, do you think we're closer to the bottom on the headline index that's on the Nifty? Would that be fair to say?
Yeah, it'll be fair to say because, if you look at markets, whatever concerns of, valuations were more in the, the larger market, like small cap, mid cap indices had these challenges of valuations. I think on a large index, Nifty, reasonably, comfort on valuation front, plus all those factors you mentioned, economy on a better track, especially, the December GST collection was pretty good at, double-digit collection growth we saw for quite some time. So yeah, macroeconomy angle, things looks okay. The government policies in place, RBI policy also has changed the, the dynamics in terms of giving a lower rate environment we've started. So that way looks good, yes.
Good, but as we speak, currently at the low point of trade for the frontline indices, the Nifty below that 22,900 mark, and it's been led lower by a couple of these, a lot of the domestic-facing names itself. We have Grasim, which is at the low point of trade. We have Shriram Finance lower as well, BPCL lower, ONGC, Bharti Airtel. After that up move that we saw at the open itself, that's been sold into currently at the low point of trade. And we are seeing some declines in a couple of these auto names like Hero Moto and Eicher Motors too. On the way up, however, some support coming in from IT. LTI Mindtree has moved to the high point of trade. Tech Mahindra is doing well, as is HCL Tech. So the IT index comes up for you, the Nifty IT. That's telling you that there is some support coming in from that part of the market. M&M, interesting, very, very interesting, was down 4% in yesterday's trading session, opened as the top Nifty loser. That dip has now been bought into, and the stock is marginally in the green. Krishna, you did say that maybe, at the headline index, we seem to have made a bit of a bottom. But going forward, if you had to deploy fresh capital, what sectors would you deploy it in? Where have the valuations become a lot more reasonable vis-a-vis expectations? And where do you think there is a better chance of you outperforming, the market over the next 1 year itself? And where would you pull out your money from?
Yeah. Yes, I think, in the context of valuations, over and above the sectoral dynamics, I think one needs to be slightly more, receptive to the fact that across all sectors, the large caps are more attractively valued vis-a-vis the mid and small of the same sector. So, it's going to be a little bit a combination between sectors on one face as well as, the large cap versus mid and small. And that has been the case, right? Even in CY24 or maybe quite a bit part of CY23, we had this, situation where large caps as a category would have underperformed across the sectors vis-a-vis their own peers in those sectors. So I think it's a little bit reversal of that large cap versus mid and small trade. Coming to sectors, clearly today, financials looks interesting category from a valuation front. We are possibly at the bottom in terms of, what we've seen historically on financials. Earning growth is on track. Even last quarter or so, financials continue to report a nice earning growth. In fact, if you look at quarterly, financials are almost 40% of NSE 500 profits. So it's a large, profit surprise or profit growth coming from that segment. Financials are interesting. Yeah, consumers can be a nice sweet spot for, a lot of volume growth, stroke profitability growth, because post budget, that a large number of 80,000 crores to 1 lakh crores range for tax saving by, individuals, which can flow into consumption related activities. So those two looks, a good spot. I think IT pharma has their own challenges, partly emanating from outside India in terms of what can happen to tariffs. So it's slightly difficult to, gauge any policy action coming from US on tariff front. So no clearly view right now. Let's wait for a month or so, for US to really spell out what they're looking to do on tariff front.
Okay. By the way, the news from the screen is not very promising. Look at the mid-cap index already. It's down about 0.7%. There's a familiar pattern that we open and then the drift down starts. Even the Nifty is now down 60, 65 odd points. And I just want to point out one more thing. The VIX has been moving higher the last couple of days. The VIX has now crossed 16. I mean, it's still not at the high seen just before the budget. That's when the VIX had really spiked because of volatility, pre-budget volatility. It moved up to almost 18. But nonetheless, and this is a big move. I mean, this is just today we're talking about 16 on the India VIX.
And this is after all the major events are out of the way.
Yeah.
That is something that is a lot more, noteworthy than had the VIX been rising ahead of the RBI policy meet or the budget or maybe Modi-Trump, tariff sort of meet.
And one more point, in yesterday's trading session, we ended high with a gain of around 30-40 points, but the VIX moved up. That's normally not something that normally happens, right? You normally see the VIX move in an inverse relation with the Nifty move, but that's precisely what's happened. But 50-point downtick on the Nifty, you'll take that, some kind of consolidation. I'm keeping an eye out actually on the number of stocks advancing. It's still closer to around 900, 950 stocks. You want to end somewhere in this vicinity because in the past we have seen that number, once it slips drastically. Even 750 stocks as we speak.
I thought you were going to say you're watching out for 22,800. Whether it'll be now quadruple is done. Now what penta, some bottom, I don't know.
We'll get that.
just as you spoke about that, 900 stocks advancing, just 750. It became 750. So that's the ferocity with which the market is declining. Though HDFC Bank has continued to hold well. It did recover from the lows and currently holding in the green. Yesterday it was HDFC Bank and Reliance, both of them led the recovery. Reliance isn't falling much, down about 1/3%. HDFC Bank is actually at the higher end of today's limited trading range so far. So those are a couple of things that we'll keep an eye out on too.
By the way, just pointing out, ACC, Grasim, a couple of these stocks are down quite a bit. Borosil, Nigel had spotted early in the morning itself. It's about 12% lower. The company posted the transcript of its investor call on the exchanges last evening. Maybe there's something that the street didn't quite like over there. We'll get more details on it in a bit. But anyway, in general, there is a bit of a mid-cap unwinding that's already underway this morning. Krishna, and that's the question, this whole mid-cap pain. And it's not institutional. It's not just the FPI selling. When FPI sell, larger stocks fall. And domestic institutions have been still net buyers and their patience and faith is really getting tested. What do you make of this whole mid-cap unwinding that's going on? And what's the buzz that you pick up from the street? I mean, is this because of sell orders from large HNIs? Is it, direct retail? How much is it, margin issues that are playing out? What are you picking up?
Yeah, I think there will be always those kind of, dynamics which might play out on either margin or some selling. But I think let's look at a big picture again, simple. The continuous selling by FPIs have made, large caps far more attractive. So even from a domestic portfolio manager looking at, with a flexible mandates like a flexi cap or a focus or a funds, where fund manager actually have a mandate to increase their large cap allocations materially vis-a-vis what, they were running in the past. It really makes sense to do some sort of a tilt in the portfolio because, finally valuations is what we should look at as an investor, and large caps are becoming attractive mainly because there is this, continuous selling by FIs.
Right, and you said that large caps look a lot better than mid caps. That was earlier the reverse case, where in a particular sector, the second or third rung players would do a lot better. So do you bet now on the return of quality? And if yes, then in that as well, what are the sectors that are best placed? You like financials, you said.
Yeah, sure, but I'll not really equate, this to only, return to quality kind of comment, because there are quality companies even in mid cap and small caps. Essentially, what we're witnessing really is that there are quality companies across the curve. It is just, that the money flow was chasing far more towards the mid cap or maybe small cap end of the segment. And that adjustment is perhaps got, tilted because FPI selling started coming in. I won't really see only quality as the primary variable behind this because, there are quality companies also having come down on, on a stock price front. But it looks more like a valuation adjustment playing out. In a way, what we're witnessing right now is a classic reversal of what we would have seen in the last year first quarter. For example, look at March 24 versus what we're seeing right now. It's just nothing but in a way, a reversal of what was playing out there. So it's not really only about quality, it's also about valuation.
All right, Krishna, appreciate you joining in and filling us in with your take on the market. So thanks a lot for joining in. Well, let's focus on another corporate, Cummins India. The company reported a good performance in Q3 that was led by the double-digit revenue growth. To discuss the outlook for the next fiscal, we're now joined by Shweta Arya, the Managing Director at Cummins India, from the sidelines of the Kotak KEI Chasing Growth Conference. Hi, Ms. Arya. Thanks a lot for joining in. Well, let's start off with what is your view on the domestic as well as exports market for the next couple of years? That is 2025, 2026. How do you see things panning out?
For financial year 2025 and for financial year 2026, we expect positive growth in the domestic segment, largely driven by the power generation segment, as well as some of our industrial segments, and continuous growth in the aftermarket. So our anticipation is for financial year ending 2025 and financial year 2026, both the years we anticipate double-digit growth. For exports, the end market demand is still not showing a very clear trend. We have been focusing a lot in improving our channel presence, making sure our products are available. There is reach that we provide through our channel in different markets. So our efforts are continuing in that direction, yet we don't see clear demand trends from each of the different markets that we operate. So it's a mixed bag in terms of anticipation from exports in the coming financial year.
Okay, so you're saying domestic demand is looking robust, but export markets, you're still awaiting some more clarity. Another third quarter was the second quarter after transition to the new emission norms. So have things settled now? How is the overall demand environment for these CPCB4 plus gensets?
So on the ground till December of 2024, CPCB2 inventory was available. There was CPCB4 selling in the market from 1st of July 2024, but there was inventory of CPCB2 available. From January 1st, we will see across the channel in India only CPCB4 plus product. So till December, there was very good demand in the lower than 800 kilowatt hour product range, which has moved to the new emission norms of CPCB4 plus. Now we will see how this plays out. We definitely believe that there is demand in the power generation market in different segments in the ranges where CPCB4 plus is applicable.
And what about the order pipeline, Shweta? How is that shaping up? What's the kind of visibility that you have here?
These are not all long-term orders. These are short-term, shorter lead time orders. So we do not have visibility for very long-term. But as far as I can talk about today, we have a healthy order board available for the next few months.
Okay, all right. Could you tell us what is the margin trend going forward?
See, our margins, since we play across power generation, in the power generation across the ranges in low horsepower, high horsepower, medium horsepower, and then in the industrial space in segments like rail, defense, marine, oil and gas, and then the aftermarket. So our margin is a blend of all of these different segments. So in every quarter, there could be a slight change in the margins. Our endeavor is to always improve our margins. We work on cost optimization of our products to be able to provide right value to the customer. We work on improving our manufacturing operations, where we can get in more efficiency and more productivity. So our efforts are in that direction. There could be a quarterly difference based on how the mix in our portfolio plays out.
Okay, all right. Well, could you help us out, though, with a margin range at least?
Nothing specific. Our endeavor is to grow profitably so that we manage our margins and bring in even better margin growth or even better profitable growth.
Okay, what about the competitive intensity, Ms. Arya? I mean, how is that shaping up with peers introducing their own products in the market as well? How is the tech being received in the market for these gensets? And are you able to command, say, better premium on your products?
I would say that we are seeing competitive intensity in the market. All our competitors have launched a full range of CPCB4 plus product. Like I said, the switchover to CPCB4 plus happened July 1st, 2024. There was some channel inventory available till December 2024. So we will now see how competition plays out over this quarter and the next.
Okay, so you're saying that you will see how competition plays out over this quarter and the next. So let's talk about now itself. How are your products in this priced versus the peers? Because both purchase of equipment and, you know, from a lifetime running cost perspective, India is a very competitive market. Do you think this incremental market share would come at the cost of profitability?
We would say that we have been there in the Indian market since 1960s. We have presence, we have a formidable aftermarket presence as well. We also launched, if I were to very specifically speak about the power generation market, we launched our CPCB 4 Plus product on July 1st of 2023. For the whole year of 2023-24, from July 1st, 23 till July 1st, 24, CPCB 2 and CPCB 4 Plus, both products were available. We did sell CPCB 4 Plus products in that time frame, and that gave us a lot of advantage in terms of managing what we call initial teething issues in the product. It helped us improving the quality and reliability of our product. So I would say that definitely gives us an advantage. We were able to see the product performing in the field in that time frame.
All right, Ms. Arya, do you see any threat from BESS, that's battery energy storage systems, and other alternatives as battery costs, they've continued to decline?
In the power backup space, we believe over the longer period of time, batteries could be a possible solution. The way we see it is that our end customers will probably have different energy sources. You can have grid, you could have solar panels, you can have battery. We do see a place for gensets even in that scenario, because for a longer duration of time, providing reliable power is what gensets can do today. We need to see battery prices falling even further, and every day there is research happening in battery technology, battery prices, there are different chemistries available. As we see it today, we see gensets being a part of the overall energy solution for our customers.
Got that. By the way, that's an update, interesting update coming in from BMC here in Mumbai, asking MGL for a lot of these institutions, bakeries, hotels and roadside vendors. I think they have to switch to some clean fuel. We'll try and get more details on this in a minute.
So, you know, a lot of the bakeries in Mumbai, there are around 5,000 or so. All of them were asked to shut operations largely because they were using, so to say, unclean fuel, and that was causing a fair amount of pollution. We have been speaking about, you know, the air quality in Mumbai, etc. And now, with them having asked to shut operations, they've now directed, the BMC has now directed to MGL saying that you have to cater to these guys as well. Is this a big business positive for MGL? Not so much, just a mild positive that, okay, these were the businesses that were affected by the BMC's direction on clean fuel, and now they've been directed, to use fuel from MGL. Yeah. Slightly incremental business positive coming in out there, but this is more environment positive than business positive. The stock has seen a bit of a recovery, but at what cost do they supply to these guys, and do they have the necessary infrastructure to supply to them or not, is also the big question. We need to know the timeline and all of that as well.
And I guess a lot of the larger establishments anyway would have been, working on CNG.
So this isn't about the larger establishments. This is about the smaller
vendors,
the roadside vendors, the roadside bakers, the unorganized lot, basically.
Yeah. So anyway, I mean, not much of a volume impact over there. But to get back to that conversation with the management of Cummins, Ms. Arya, I just want to go back to the point on exports. You said that, of course, you need more visibility in terms of demand, but there is a recovery that seems to be, visible as of now. So can you tell us which regions are doing well and which geographies are still, so to speak, struggling? What's the outlook?
For exports, it's very difficult to say that here's one geography which will really take off. We have seen in a particular quarter orders coming in from one geography and in the other quarter coming in from another geography. So still the geopolitical situation hasn't stabilized as much, and we are not seeing clear demand trends from one particular geography. Our endeavor is to improve our product availability, make sure we have fit for market products for those end markets where we are selling, and also make sure that we have the right channel partners to be able to sell our products in those end markets.
Since we're speaking about exports, can't take your eyes off what's likely in the US. Do you foresee any impact coming in from Trump's tariff policies on particularly your export business?
We are evaluating this at this point in time. It is a wait and watch situation. Not all tariffs are announced yet. We are evaluating on how it impacts which geography in which way.
All right. And is the best of your margins behind you? And I ask this specifically because you had in the conference call mentioned that, the peak of the gross margins is what you saw in the prior quarter. So the question is whether this sustains or maybe from here on it's only downhill from a margin standpoint.
So gross margins for us are a play of the product mix. Since we are present across various segments in power gen, in industrial, and there's aftermarket, there is a segmental play there and there is a product play there, product mix, which plays across our margins. The margin is a blended margin of all those products. And we believe that there is room for us to improve our margins because there are cost reduction efforts that are ongoing, manufacturing operational efficiencies that we are building in. So we believe that we can improve our margins.
Okay, you believe that you can improve your margins. Your shareholders will like that. So finally, the big picture questions, FY26, what is the outlook? If you can, leave us even with a guidance band of sorts, revenue, and since you're talking about margin improvement, how much? Is it a, rough target you're working with?
For financial year 26, we believe that we will be able to sustain the double-digit growth from a revenue perspective. From a margin perspective, as I mentioned, it is a mix play here based on which product portfolio sells in which segment. And we continue to put in our efforts to improving our margins and delivering profitable growth.
Sure. Okay, and finally, a broader question on the industry. This whole talk about, private capex. Do you see a pickup on the horizon?
We believe that with this budget being announced and 11.2 lakh crores of capital expenditure by the government is trying to draw a balance, in our view, between government capital expenditure and trying to boost private capital expenditure. We haven't seen it happening just yet, but our belief is that it will pick up in this year.
All right, take that point. Thank you, Ms. Arya, for joining in and giving us an outlook into your business on the competitive intensity and the near-term views on exports and the domestic market itself. We wish you good luck at the conference and for your business going forward as well. But just before we slip into a short break, Nigel, we were talking about 900 stocks advancing, that going down to 700. Now that's down to around 524 itself. The decliners moving all the way up to 1900. Though all is not lost, I'm looking at a couple of stocks which have seen sharp recoveries from lows. We were talking about Godfrey Phillips as, the stock of yesterday up nearly 17-18%, and this month up 50%. It opened lower, maybe on account of some profit booking, so it was lower by about 5%, and that itself has been bought into. The stock has recovered about 11% from lows, up around 3% now as we speak, and that's taken this week's gain on the stock itself up to around 21%, and this month's gain to 61%. So report good numbers, do better, and the outlook for the industry improves, the street rewards you. Whereas on the other hand, stocks that were, seeing a bit of decline, or rather seeing a bit of an up move at the open, have now been sold into. Westlife Food is one of them. At pre-open was higher, opened about 3-4% higher, and from those highs, the stock has actually corrected about 6%, currently at the low point of trade.
Okay, all right. On that note, let's quickly take a break, come back on the other side, and we will connect with Sudhir Sekri, Chairman at the Apparel Export Promotion Council, and Prerna Jhunjhunwala of Elara Capital, as there is a lot of talk on reciprocal US tariffs. So what does that mean for Indian textile and apparel exports? We discuss this with the experts. Welcome back. So the news from the market is that the Nifty is stable. It's the mid-cap index. It's continuing to nurse a cut of around 1% at this point in time, and the market breadth is still quite weak. Let's pull up the advanced decline ratio. It's the mid-cap index, advanced decline ratio. Still far more many declining stocks. Let's see if this improves as the day progresses. For the time being, we're putting the spotlight on the textile and apparel sector. Of course, after US President Donald Trump has issued that executive order on reciprocal tariffs, the fear is that perhaps either India will have to reduce its own tariffs, imports coming into India, or the US is going to be increasing tariffs on many of the product categories and lines. The issue is, how does this impact big exporting sectors out of India? We discussed what happens to defense manufacturers the other day, and today we're putting the spotlight on textiles and apparel because it's a huge export industry for us. So joining us are Sudhir Sekhri, Chairman at the Apparel Export Promotion Council, and Prerna Jhunjhunwala, Vice President Equity Research at Elara Capital. Thank you very much for joining in, ladies and gentlemen. And I'll start with the lady. Prerna, let's go with the numbers first. Textile exports into the US, but companies have done a phenomenal job, right? Groups like Wellspun and so many others, Gokuldas Exports, whether it's textiles, terry towels, linen, apparel themselves. So India's done a phenomenal job. Now, is that whole story at risk if the US suddenly increases the tariff barrier, several fold? What are the numbers telling us? What is the export picture now?
So if you look at the US imports, India's market share in home textiles is at around 61.4%, 61.5% approximately. And for terry towels, it's around 45%. For garmenting, it's around 7% odd. So we are a big exporter to US in terms of home textiles, and we are gaining market share in the garmenting business. So it is definitely an important geography for Indian textile exports. Now, in terms of tariffs, if US puts in tariffs, there could be an impact for the cost structure that US importers will have to take into account because of the increase that happens due to tariffs. But at the same time, we'll also have to see how India can be replaced. I don't think so. Such a big geography, India can be replaced in US's imports of textiles. And where do the country finds another alternative? So all these are challenges. Textile industry is a complex supply chain wherein imports happen from multiple countries, but not one country or a few countries can satisfy other countries' demands and skill sets. So hence, we believe that, tariffs could have an impact. There could be talks with the importers, but how much and if at all tariffs comes to India in textiles, we'll have to wait and watch.
Okay, by the way, let's just pull up this table. I think we'll have it. This is a calculation done by Nomura, and it's talking about the total differential tariff. Basically, if you net off how much we're charging for US imports coming in versus what they're charging us, this is a net. So our tariffs obviously are higher, and the differential is as high as 17% in footwear. Food products, it could be 35%. Textiles, about 15.5%. Let's come to Mr. Sekhri as well. Mr. Sekhri, so isn't this a straight area of concern? If the US increases tariffs, what is the blended tariff? What is the import duty one has to pay as of now for apparel exports that are going into the US?
Yeah, and as far as apparel is concerned, I don't think there's much of a concern that we have. Let me explain to you why. You've shown a difference of 15.6% in a difference of tariffs in the textile area. But when you cover apparel, just apparel, the difference is much smaller. It's to the tune of about 7%, because the import duties of garments into the US range from 2.6% to 32%, 33% as a matter of fact. Man-made fabrics, for instance, attract duty as high as 33%. It's the cotton where the duties are lower. Now, I do agree that our exports to the USA are more in cotton fabrics, cotton garments, which forms about 65% of our total exports, whereas the other 35% is rayon or man-made fabric exports. However, if you balance it out, I think the average duty that works out is about, I mean, we're still working out the exact details, but it works out to something like 19% if you see an average and the actual export that is being done, being made in the two categories of cotton and man-made fabric. Now, as far as import duty is concerned, import duty on apparel is 20% with a 2% surcharge. And in certain categories, of course, it goes by it's 45 rupees per piece or 20%, whichever is higher. So if you average it out, it comes to about 24%. So not 24.5%. So if you see the differential is about 5.5 to 6%, as opposed to textiles, where it is, appears to be 15.5%. So, however, why I said that there's not much of a concern, because, if you see it pragmatically, there is a demand for Indian apparel. And if the duties go up in the US because of higher duties in India, I mean, that will affect our neighboring countries also. Our competitor, for instance, China is our biggest competitor. And China, we all know that they are being, huge duties are being imposed on China. So China is actually out of the picture when it comes to competition. They are not going to eat into our business at all. On the contrary, probably we are going to eat into their business. We'll get part of their business. Similarly, our other competition is Vietnam, Bangladesh. Bangladesh, which is in our neighborhood, they have their own problems. Their business is not, I don't see any increase in business happening there. I won't say the business will go down, but the 5 to 10% increase they were seeing annually, that is not going to happen because of the political situation over there. So, all said and done, in spite, even if our duties, the government, first of all, we don't know whether the Trump government is going to increase duties because of this slight differential. But I'm saying, even if, as a worst case scenario, even if they do, I don't see our business getting affected in any way.
All right, we take that point, and fair points made out there. The harm would be a lot more on neighboring states like Bangladesh, Vietnam, and China, who have been eating away our share of exports as well due to some of their policies. But now they're in economic doldrums. But as you were speaking briefly, the Nifty and the Sensex moved into the green. It was led by the IT pack, and it was led by HDFC Bank. We're pointing out that HDFC Bank has been doing well despite the weakness that we're seeing in the market. HDFC Bank at the higher end of today's trading range so far, and the IT index as well. So both these heavyweight sectors actually, contributing. Though just keep an eye out on the Nifty Bank itself, down about 1/3%. Recoveries are being sold into as well. But let's get back to our conversation with Sudhir and Prerna. Sudhir, just a follow-up on what you said. Duties being increased is one thing. The bigger differential is the cost of production. So even if the duties are increased by a certain proportion, the cost would still be a lot cheaper to import as against manufacture locally or look for other alternatives. So if you could give us a sense on, what is the cost differential between Indian products and the ones that are made by our competitors and exported to the US versus what's manufactured in the US itself. That's point number one. And secondly, with the depreciation that we've seen in the rupee, which is much more than what we've seen in some of our peers, how much does your cost advantage improve by?
Okay, let me take it one at a time. See, first of all, when we talk about the cost advantage between that Bangladesh probably has because of their low labor cost over India, that cost advantage would remain even if the duties go up and down. So that cost advantage imbalance will remain. Now, you ask the question whether the manufacturing in US, so there's hardly any manufacturing of garments in the US. Of course, there is manufacturing in South America or Latin America. But again, you know that Mr. Trump is going to impose some duties there too. So I would think that as far as duties is concerned, I think we'll have to see it separately. And because it does not really affect the cost of production. That was your first question. And what was your second question, please?
The depreciation in the rupee, how much has that been an advantage?
Well, of course, definitely, this is going to be a big advantage for exports. We've already seen a depreciation of about, 3 to 4% till now. We expect another 2-3% depreciation. And this means that obviously if I give away the entire gains that I have made to the buyers, then the buyer stands to gain 5 to 6%.
Sure.
The whole lot of money.
No, absolutely. And we have to see how these negotiations go, because the US president has very clearly said the tariff is just one piece. He's looking at a lot of other aspects, including currency, which could be making exports coming into the, or the imports coming into the US cheaper. Very quickly, Prerna, on you, I mean, from a stock perspective, as these negotiations play out, we'll only have clarity, I think, around the 2nd of April or so. Right now, the textile and apparel stocks under your coverage, are you changing any views, anything? And what are your picks? What do you like the most in the whole sector?
Among our coverage, we like Arvind Limited and KPR Mill. Given the price correction in the stocks, they look attractive at current prices. We're not changing our view as of now, as we don't know what is going to happen and what kind of tariffs would be imposed, and will there be any material impact on these stocks. So we'll maintain our positive view on these stocks.
Okay, all right. Ladies and gentlemen, thank you very much. Slightly shorter conversation, but we would definitely want to revisit the issue once we have some more clarity on the, the final tariff lines that are agreed upon between India and the US. But there's AEPC maintaining that Indian apparel exports will not be impacted. Well, with that, I think we have to quickly move on to our next guest, and we're putting the spotlight now on the IT sector. The sector, of course, has reported a mixed performance in the 3rd quarter. So what lies ahead, and are these green shoots of demand really blossoming into full plants and maybe even trees later down the line? We have with us Kawaljeet Saluja, who's Senior Executive Director and Head of Research at Kotak Institutional Equities. And, of course, he's joining us from the sidelines of the KIE Chasing Growth Conference. Kawaljeet, thanks so much for joining in. In a market that's beaten down so badly and confidence is so low, we keep looking out to tech as some island of safety. But beyond that, that's a tactical positioning point of view. I mean, I want to start with the real growth question and what stood out for you. Before we talk about large caps, actually, let's talk about the tier 2 companies, whether, any of them really fired up your imagination.
Well, I think, what's been happening in the sector is essentially a gradual recovery. What you're going to get, in our view, in FY26 is a growth rate which will be better than FY 2025, but it will still not hit the normalized level of growth. And the reason is because the growth recovery is patchy. There are segments in the market that are doing well, which is financial services and retail. And at the same time, there is deterioration in the manufacturing vertical. Now, within this spectrum, what is happening is that some of the challengers are doing better than some of the incumbents, especially the likes of Coforge and Persistent, which seem to be firing, all guns and actually would end up reporting growth rates which will be materially better than the peers. Again, having said that, not all challenges are the same. Not all incumbents are the same. There are basically a mixed bag of performers in both the segments of the market.
Okay. We'll come to the mixed performance in a bit. But now at a headline level, now I'm talking about the traditional IT services companies, the big boys. There, Kawaljeet, what are the different trends that are emerging? Most of them, I remember the commentary, you were talking about sort of cautious optimism and seeing some improvement in demand in North America. So for FY26, what's the kind of growth in the business that you're penciling in?
I mean, essentially, it's a recovery. It's a very gradual recovery. It's a frustrating recovery as well. So let's say if you're penciling, if these companies would have grown by around, on an average, 4 to 4.5% in FY 2025, then at best you can pencil in 6.5 to 7% growth in FY 2026. Again, there'll be dispersion in growth rates depending on a couple of factors. One is the large deals and mega deals. I mean, there are not many of those. And second is the contribution of revenues from verticals that are in a state of recovery versus verticals that are in a state of challenge. So FY26, again, at a broader level, there will be some improvement. But within that, the dispersion in growth rates will again be there, as you saw in FY25.
All right. Hi, Kawaljeet. Nigel on this side, and good to have you on the show after a while. You know, the argument is that global IT peers, where you look at Cognizant, you look at Accenture, they're trading at relatively cheaper multiples in comparison to what our Indian companies trade at. Could you tell us your comment on that? Justified? How does it shape up?
Accenture, I think the valuations have almost converged with Infy and TCS. Cognizant, you cannot compare on valuation because the growth rates are lower and the company is in a turnaround phase. So, so to that extent, there are not enough number of global services companies for comparison. But when it comes to specific, it's just the factors that I just laid out.
Right. You spoke about valuations converging with TCS and Infosys for some of these companies, but TCS, which is up only 3% in the last 3 years, has been an underperformer. It's one of your top picks, and you do acknowledge that, it'll be difficult for the company to backfill the loss of revenue from the BSNL deal in FY26. What makes you still bullish on TCS?
The BSNL deal does not change the EPS, right? It's a zero margin deal. So the only thing is that the top line becomes lighter, the margins go up, your EPS growth will still be around 9 to 10%, yeah. So think about BSNL as empty calories for now, yeah.
Okay.
Empty calories, okay. Usually we try and avoid them, but then again. So, to go back to the point, and I'm just simply asking from a, portfolio positioning point of view, are you better off, if someone has to allocate fresh capital to Indian IT, are you better off being with the safety of the likes of TCS or Infosys? Or should you look at, Coforge and Persistent, the companies that have been showing growth? Or should you go to the third leg, which is some of these ER&D companies like KPIT Tech, Tata Elxsi? They've had a bit of a rough ride last few quarters. Do you see that, also recovering? Where to put the money in IT?
Okay, so I'll give you a boring answer. First of all, for the time being, avoid engineering services because there are headwinds in engineering services across multiple segments, whether in autos, whether it's in high tech, etc. So I would avoid engineering services. When it comes to between the incumbents and challengers, there has to be some fun, right? And there has to be some sugar as well, rush as well in names like Persistent and Coforge. So you end up buying, I will recommend Coforge because the growth will be turbocharged, far, far better than what basically the street is building in. 20% plus organic growth in FY 2026. The stock has come off, so we'd recommend Coforge. And Infy and TCS, one can basically pick any of them at the current levels. I'll just say that Infosys nudges ahead purely because they have a higher discretionary exposure, and the base assumption is that in FY26, discretionary spending will recover. Then maybe the growth rates will end up being better in Infosys. So Infosys, Coforge, you pick one. From each category.
Kawaljeet, you're really whetting our appetite this morning,
huh? If you want to have a wider portfolio.
Yes, go on. I'm saying you were really whetting our appetite with the empty calories and a little bit of sugar rush with Coforge and then Infosys. But please complete the point. You're saying maybe Infosys can edge ahead on the growth. But please complete.
No, but if you want to basically have a well-balanced, rounded portfolio, have Infy, have TCS, have Coforge. There's a turnaround play in the form of TechM, which seems to be forgotten. So there are plenty of options to look at in IT services, yeah.
Okay, right. but no ER&D. We remember that point as well because engineering in some of those sectors like autos still perhaps the recovery is still some time away.
We have some, absolutely. Some good companies, but unfortunately the macro environment is fairly challenging for them. But there are some very good companies in the space over there.
Thank you so much for joining in. The basic idea is a balanced diet and a balanced portfolio. Use the macros right with Infosys, TCS, and TechM, maybe a bit of sugar rush in terms of Coforge as well, but no more than that. Thank you for joining in and wish you a good conference as well. With that, let's go back to Nigel, who's standing by at the wall to talk us through the market outlook from top voices of few brokerage houses. Over to you, Nigel.
Well, let's get you what the top voices are saying. Rhythm Desai of Morgan Stanley, well, he says that Q3 earnings growth was up sequentially, which was better than the subdued expectations. He goes on to add that the market looks good in the near term and we could be in for a near-term bottom, given that improving growth. If global cues do not surprise negatively, he adds that India should resume its outperformance in comparison to the emerging markets, and that could be rather soon. They're overweight on a few stocks, which include L&T, Bajaj Finance, ICICI Bank, Mahindra & Mahindra, Titan, Trent, Maruti, while they're underweight on Eicher Motors, RBL Bank, Wipro, Concord. So that's about Morgan Stanley and his stake. Moving to Surendra Goel of Citi, he says that the headline trends in Q3, they missed expectations with the EBITDA growth of just 7% on a year-on-year basis. But he goes on to add that with a pickup in central government capex in the past few months, the budgetary support to the consumption space and also the start of rate cuts, he expects growth to pick up. But also goes on to add that the impact of the reciprocal tariffs from the United States will be something that could impact select sectors. After a decline of 12%, well, valuations at around 19 times 1 year forward is below the 5-year long-term averages. And the FIs, well, they're underweight on the benchmark, which is the highest that they've seen in the last 15 years. He winds down by saying that India looks relatively well placed post the correction, and their December 2025 Nifty target is 26,000. Moving to Rajiv Batra of JP Morgan, he says that Q3 was another subdued quarter with regard to earnings growth, which was driven by moderation in urban consumption, tighter liquidity, a depreciating rupee, and also the rise in input costs. But now they expect a nascent recovery in Q4 earnings on a sequential basis, and that's because of sustained upswing in rural demand, a rise in government spending, and also lower raw material costs. They add that despite the recent earnings downgrades, consensus expectations for calendar year 25 as well as 26 are still elevated, and that's why there could be further downgrades specifically in energy, materials, industrials, as well as passenger vehicle plays. They reiterate, though, their overweight stance on financials, consumer staples, consumer discretionary healthcare, as well as real estate. Well, let's wind this down then with a technical call coming in from Lawrence Blanco of CLSA. And he's particularly commenting on the dollar index. He says that the dollar index is strengthening the 103 support, though in the past 3 months, the US dollar index has been capped at around that 109.8 to around 110.18. And they found some kind of support in this vicinity of around 106, 107 area. A break below this mark of 106, 107 support would suggest that December's breakout, from that 2022 to around 2024 trading range was not genuine one, leaving the dollar index could head back to around that 99 to around 100 mark to that zone of around 106, 107 trading range. Within the old range, the 200 EMA offers some kind of support, the near-term support at around 104.8 area. So that's what all the top voices are saying with regard to the Indian markets, as well as Lawrence Blanco winding it up with the technicals.
All right, we take that point. Nigel, Lawrence Blanco winding it down with the technicals. What we'll do is we'll wind this segment down, take a break, come back. On the other side, we'll have more technical trades coming in from Mitesh Thakkar and Sudarshan Sukhani. Welcome back. Recoveries are being sold into. Now the mid-cap index down about 0.75%. Look at Zentech. It's locked in 10% lower circuit, despite the management saying that they will meet the 900 crore revenue guidance with 35% margins as well. So the street is in the mood of, taking money off. The promoters said that they have no intent of buying in the open market right now. Then we are seeing some decline in a bunch of other stocks as well. So, Jubilant Pharmova lower at the day's low, Hindware Home, among others, are selling off, and Strides Pharma from the frontline F&O stocks also at the low point of trade. Let's go across to Mitesh Thakkar now. Mitesh, your trade's at 10. What do you have on your list?
I have one buy and one sell call. On the selling side is Ambuja Cement with a stop at about 487 for targets of 460. And Kotak Bank is a buy Keep a stop below levels of 1930 here and look for target of around 1995 2000.
Okay, all right. Mitesh, thanks for those trades. We will come back to you later in the course of the day. Right now, another quick break. Market's still down about 45 points in the Nifty. Back with some moving stocks in just a bit. Welcome back. Let's focus on a couple of stocks that are in news this morning. MGL is reacting to that update that was flashing on the screens just a while back, which basically deals with BMC issuing a sort of directive saying that all the smaller, perhaps street side vendors, etc., operating in Mumbai, they need to switch to clean fuel. Now, what exactly does this mean? And is it material at all for the company? Let's ask Sudarshan. Sud, what's happening here?
The reason the stock of MGL is in focus because Mumbai Municipal Corporation, or say BMC, has issued directions to all the roadside vendors or say eateries or dhabas to shift to clean or eco-friendly fuel. And it's categorically saying that either adopt CNG or PNG instead of polluting fuels. And it's on the back of the recently High Court orders saying, basically High Court had issued directions to BMC to ensure that all these dhabas, it is shift to these fuels and in a specific timeline. So now BMC has to come out issuing directions to these eateries, dhabas to shift to this clean and eco-friendly fuel, and the deadline is given is of July 8. And BMC also has issued notices to more than 84 restaurants and eateries and dhabas in Lower Parel and Prabhat Devi, and it says licenses will be marked as not to renew until the transition is completed. Also, no new licenses will be issued to establishments using conventional fuels if these eateries and dhabas don't shift to eco-friendly fuel by July 8. So it's important for MGL because it's the biggest player in the city as far as the clean fuel or say CNG or PNG is concerned.
All right, it is good news for MGL in terms of business opportunities, Sudarshan, but all of us here are tempted to ask you, which is your favorite dhaba or eatery in the city?
I don't stay in town, so I stay in Dombivli, so I can't talk about it.
You work here, you work in Worli, you work in Lower Parel.
No, I don't have any favorite.
So Darshan likes his
He's a healthy guy. He has green tea and he only has his high-protein diet. Home food is the best. There we go. All right, Sudarshan. Thank you so much. Well, let's quickly move on. I think we have another management in focus.
Well, that's right. Rallis, that's the one on our radar. It was a challenging Q3 for them. The company did report some kind of weakness, both in pricing, exports as well. They saw a degrowth in revenue due to a significant fall, in fact, in exports. My colleague Vamakshi caught up with the MD and CEO, Mr. Shukla, from the sidelines of the Kotak Chasing Growth conference and began by asking the reasons behind the slowdown. Let's listen in.
When you look at Rallis, I think it is very important to understand Rallis operates in multiple segments. One of our businesses is domestic and then export. On domestic, we have crop protection business, we have biological business as well as seeds business. So when you look at performance of biologicals and seed business, I think they have done very well. Even on crop protection side, domestic business has done very well. On volumes, we are up. Obviously, industry is going through a very difficult phase where prices remain subdued. As a result, performance may not exactly be what it looks like in the number. Our biggest challenge has been export market, where global commodity prices are low. We are also dealing with some of the legacy product where because of the excess demand-supply situation, prices and volume both are subdued.
All right, but what is your outlook going forward when it comes to the volumes as well as the pricing? Because even though the domestic business has grown by 2.5%, the pricing over here has still declined. Similar is for the exports business, where we're seeing both a 34% volume decline as well as a 4% price decline. So going ahead, do you think the decline in volumes and the declining in prices will continue, or have prices stabilized now?
So global situation still remains very challenging, where commodity prices are low, farmer earnings are still low. As a result, and we are also stuck with the, what you call, legacy portfolio. So global business, I think we have seen the bottom. Things should only look better from here. But you have to understand our business. It's a very seasonal business. It is very, very difficult to judge rallies based on the quarter, because these quarters overlap from Kharif, Rabi to different seasons. What I want to tell that our company is going through a transformation process. We have identified some gaps, and we are trying to work on those. For example, we believe our seed and biologicals portfolio can do better from here. That's a area which is growing. We are focusing a lot on that. Within the crop protection portfolio, we had weakness in the herbicide business. We are fixing on that. I also believe the efforts we are taking on the demand generation side to get more focused on the domestic market should also start giving us volume momentum. Prices, of course, I cannot control, because prices are driven by what happens based on the global demand and supply situation.
Well, so you're saying that volumes, the degrowth that we've seen, that is going to end now, especially on the exports part. Now, from now onwards, if we compare on a quarter-on-quarter basis, it's going to improve. Is that what you're saying?
Well, based on the orders we have and based on the conversation we are having with the customers, looks like while prices continue to remain low, but volume certainly should start picking up.
Sure, that's quite promising. And, briefly, you mentioned about how you're changing, so now you actually had planned a portfolio cleanup as well as a leaner organization structure. So I wanted to ask you, is the churn in the product portfolio, at least, is it largely through? And another question on that front is, when will the benefits of this start flowing through, and how will it exactly impact your own profitability?
So our focus remains to improve profitability. We are in a seasonal business. We get only one chance in a year to sell to the customer. But some of the efforts we are taking in terms of making our organizational structure leaner, trying to pivot more on the customer, leveraging digital, also cleaning up the portfolio. We have recently evaluated and done with the exercise of looking at the tail portfolio. We are certainly going to deal with as we enter into the new season in 2025-26.
And what would the improvement on the profitability be on account of this sort of restructuring?
So it's very difficult for me to give you a short-term projection, but our long-term goal is that on a continuous basis, we should improve our return on capital employed. And it has to come from combination of portfolio mix. So we need to start weeding out low margin portfolio, start adding in more higher margin portfolio. On the cost side also, we are looking at how do we utilize our assets better, at the same time manage some of our costs differently, so that the cost we incur, it is being used for more productive uses, for example, demand generation activities, etc.
All right. So when you're talking about adding more better margin products to your portfolio, you've also mentioned about metalaxyl. So it is, I think, in the final stages of being commercialized. So when will that commercialization take place? And is this a part of the products that you're talking about? And apart from this, what other products are in the pipeline that could probably, help your margin expansion plans as well? And, quantify for us the long-term potential that you see from these newer products that you plan to introduce.
So the way we look at it, our crop protection portfolio, I think we expect our herbicide, for example, herbicide as a part of crop protection contributes lowest in the overall crop protection portfolio. In domestic contribution of that should accelerate. On the seed side, we should actually accelerate our business. I think this business we had bought 12 years ago, it is now showing sign of improvement. Similarly, on the biological portfolio, I expect high double-digit growth in the years to come.
All right, and just one more question on the margin front. Your EBITDA margin was under pressure in the third quarter despite the improvement that we saw in the gross margins. Now, you mentioned that pricing did decline in Q3. So where is the improvement in gross margins coming from?
So improvement in gross margin is always a factor of product mix. As I said, we have seed business, biological business, domestic crop protection business, as well as export business. Because there was a lower export business, which is a low margin business, that has led to overall margin improvement. But we expect that business to remain under challenge because of the global demand supply situation. But we expect to continue to improve our margin on the domestic side.
Sure, thank you so much. And one last question from my end. For FY26, what could your revenue as well as margin profile look like? If you can just give, if not specific numbers, but at least something qualitatively.
See, our effort in the what you call five-year horizon is going to be that we start growing faster than the industry average. Industry grows about 5 to 7%. Our effort will be to really grow faster than the industry. But more importantly, I'm expecting significant improvement on return on capital with the combination of portfolio adjustment as well as some of the cost-cutting measures we take. So I expect at least 500 basis point margin improvement in next 4 to 5 years.